Okay, right then, it is 9 o'clock, so let's make a stop then for our corporate reporting session. My name is Farsheen Warnock, and I will be your tutor for the next 2 days for onboarding. Let's just do a bit of a sound check so I can make sure you can all hear me. Maybe you could just drop me a message on the chat panel. Let me know what the weather is like where you are. Let me know how you're feeling on this average Monday morning. Okay, so on your screen on the session, there should be a little chat panel. Sabine, great, can hear me, fantastic, great. When you do send a message on the chat panel, a little bit of a request for you, please. Could you make sure your message is directed to all participants? All participants, so that way everyone else in the virtual classroom is able to hear you. I can see that Emma can hear me, Rebecca can hear me, Sabine can hear me. Just make sure you send your message to all participants. Thank you, Harvey. Cold and cloudy where you are, okie doke. It's pretty cloudy here in London as well. The good thing, however, is now I can actually open my curtains. Last week it was so bright I had to keep them shut the whole day, so at least now I'm getting some natural sunlight in. Good morning, William. Cloudy for you where you are, Tom. All good for you. Warm and sunny from Juanta. Everyone else, okay, looks good. All good to hear. Cloudy here as well. Oh dear. Yeah, it is indeed a cloudy day. So what can we do better except to just hang out together in our virtual classroom and learn some corporate reporting. Before we get to it, just a few sort of admin points. If you are going to be sending a message, could you make sure to put it in the chat panel and avoid going to the Q and answer session, please, because I can't man both. So just check the chat panel. There should be two. Ignore the Q&A. You want to address all of your questions to all participants in the chat panel, and that way everyone can hear. Also, if you're having any problems, with the sound, then if you go to the top on your screen, there should be a button for audio. If you go to audio broadcast and refresh that button, then the sound should work. If it still doesn't work, then mention it in the chat panel. And if it still doesn't work, then mention it in the chat panel, and we'll see if we can assist. So, Patrick, I've got a message from you. A lot of people in my intake are struggling to connect. What are they saying, Patrick? Is it the sound that's the problem? Something to do with Flash. Okay. Well, let's give it a little bit of time to see if they are able to connect. So, Patrick, are you receiving messages from some students saying that they cannot connect at all, or are they logged on to the session, but are they having audio troubles? Yep, some people cannot access. I am unable to hear anything. Okie doke. Let's just see what we can do. One moment, please, everybody. Okay, so I'm just sending a message to my assistants, to my panelists, and we're just checking if there is any issue from our side. Sometimes it is just the case that it takes a little while to connect. Maybe if you log off and log on again, then that should work. So just make sure that when you log on to this session, okay, you should be using the link from the original email, not the calendar invite. I think someone has sent the link through the chat panel. So thank you for that, Sabine. Let's give it a few more minutes and hope that everyone is online. I have a question here from Vishali. What chapters will we be covering today? So the plan for today is we're going to get through chapters 1 and 2 and then break the back of chapter 3. So if you wanted to print out some copies, chapters 1 to 3 are the ones you need for today. Okay. So a question here from Edward. What time is lunch? Approximately 1 o'clock. Okay, so we'll try to follow the normal time structure of a classroom day. So 2 breaks in the morning, and then lunch at 1 o'clock for an hour, and then we'll have a short break in the afternoon. The day should finish any time between 4:30 to 5 o'clock. Okay, before we go on with the intro slides, for those who are logged on to the session and can hear me quite well, can you just let me know, have you heard from your colleagues, have you heard from your friends, is anyone still struggling to log on? Still struggling, says Patrick. Okie doke. Are you able to just message them with the messages from John Sharrett? So if they are having audio issues, then they could try going through the Communicate tab and press the audio broadcast to rejoin. Or else it's maybe worth just logging off the WebEx and logging on again. We'll give it a few more minutes. Let's hope that everyone can join us and there are no technical issues for this session. Patrick, I'm going to rely on you to be my sort of messenger here. As and when your colleagues are getting access, could you let me know? Okay, so if they're slowly managing to resolve their cases and log on to the session, just let me know so I can tell whether everyone is able to listen in or not. Thank you. Okay, so looks like we now have quite a few participants joining us. I can see there is about 94, 95, so looks like we are, that's most of us in the class. I've got a question from Matteo. Was this session always meant to take place today, or was it moved as a result of the course going virtual? We were meant to start corporate reporting courses this week, so fortunately there haven't been any changes to the schedule for the advanced courses, which is good news. So can I just get a message then Is anyone in the chat panel aware of anyone else having technical issues logging on? Is anyone else aware of their friends or colleagues having technical issues logging on? I hear silence in the chat panel, so that is music to my ears. I'm going to assume we are all good to go then. Okay, so let's make a start and to have an introduction to corporate reporting. Okie doke. So good morning, everybody. So for those that didn't catch earlier on the session when it started, my name is Farsheen Warnock, and I'll be your tutor for the next 2 days for corporate reporting. So I'll just talk you through the onboarding slides. We'll talk through your key contacts for this course, an overview of the learning pathway, and a few specifics about the subject corporate reporting in particular. So my name is on the screen, okay, Farsheen Warnock at kaplan.co.uk. Feel free to jot that down. If you've got any questions on the course, any kind of study support, tips on exam technique or questions to practice or not practice, get in touch with me. I'm more than happy to help. I also have my 2 very beautiful teaching assistants with me today. That's Rob Zeffert and John Sharrett. They are accessible via the chat panel. So we've got quite a big class going on today. I think there are over 90 attendees, and so Rob and John are going to help out with any queries that you have. So throughout the course, if you have wanted me to go over something or you had a specific question about any of the exercises, so put your message in the chat panel. If it's a question that I think impacts the whole class or something I think the entire class will benefit from, then I'll respond to it. But more likely just to keep in touch, keep up to pace with the class and to keep going with the materials. We do have a fair bit to go through. More likely Rob or John will pick up your query. Now, try to direct all of your queries to all participants on the chat panel so that everyone can see. Unless, of course, you want that question to be private, then direct it to either Rob or John, and they will be more than happy to help you out there. Don't forget other resources available when you sort of go away from onboarding and do your self-managed learning. We've got the academic support team that you can access on My Kaplan. Just go to the Contact a Tutor function on the top right-hand side. You can live chat, email, or request a call back. They generally all work from home. They sit there waiting for your call, make their lives interesting, pose a challenging question for them. Okay, I'm sure they'll be very pleased to hear from you. If you're going to send them an email with a question on, if you're going to send them an email asking for help on a question you've tried from one of the resources, can you please make sure you clearly reference where the query relates to? For example, the study manual, page 321. Try to keep your messages sort of try to keep your questions on a case-by-case basis. Don't lump all your questions into one email because it'll take a bit longer for them to respond. The most efficient thing you can do is send each question or query in a separate message, and then they can tackle the easy ones in no time at all. They'll take a little bit longer to deal with the sort of more lengthy queries. They are available Monday to Friday and the weekend for slightly reduced hours, so do make use of them. They are there to help you with any technical support you have on corporate reporting. Other key contacts you should know by now already are, of course, the PwC team at Kaplan, the PwC team ICAW at kaplan.co.uk. So go to them for anything admin related, anything to do with your joining instructions, anything to do with your materials, anything to do with getting access to your My Kaplan account. Once you're in My Kaplan, if you're having any technical issues, go to the My Kaplan support team. Okay, so materials checklist. Now, on My Kaplan, you should have an online version of the ICAW study manual and question bank. as well as the Kaplan workbook, and something called the Triathlon Sportswear booklet. So this is an extra resource designed for you to help with your self-managed learning days. There'll be a series of exercises included within the booklet that you'll need to complete as and when you go through your self-managed learning. Okay, so the top 1, 2, 3, 4, 5 items, these bullet points are all available online on my Kaplan. Okay, just in case anyone is wondering where those materials are, I can show you on the screen. So you should all have access to CR, your self-managed learning content. Just go to the content home, study material. You can see all of these PDF versions. Now, a number of you have been in touch with me independently asking about your materials. So please bear with us. There is currently a shortage. Well, we are waiting to receive more materials from the Institute, but I believe at the minute there is a bit of a halt in publication. So we are running low on inventories. You should have received communications from the PwC team asking you to complete a form to request your materials. Okay, and they will be received in due course, but for the meantime, we ask if you could please bear with us and be patient and work off the online materials. If you've got a Padlet, if you've got some kind of tablet where you can write on the online workbooks, then great. If you've got a printer, even better. Otherwise, you may have to do a bit of looking on the screen and writing notes on the page. Okay, but try to sort of find a system that works best for you. You will receive your materials in due course. It's just unfortunate not all of them have been sent quite yet. Okay. What you will also receive in due course for corporate reporting are your open books. So you've got the International Financial Reporting Standards book and your Auditing Standards book. These are the same as what you will have received back when you did your professional level, okay? Depending on when you did your professional level, that is. So my advice, when it comes to the Auditing Standards book, there are very few changes. My advice, if you've already marked up, highlighted, and made very pretty and beautiful your old Auditing Standards book from when you did audit and assurance at the professional level, then just keep that version. Okay, no point doing all the work again, highlighting it from scratch. For onboarding, we're going to need the Kaplan workbook. Okay, that is all. And then for your SML, you're going to need your workbook, the Triathlon Sportswear booklet, and you'll be using these study materials for any kind of homework. Okay, so just had a question from a private question, which I think is perhaps relevant to everyone. Just had on my Kaplan, the calendar showed some of us have case study today, so we are not sure if we are in the correct class. Okay, so you should have received an invitation to join a WebEx. Presumably, if you have been invited for this day, then your WebEx starts this day. There are actually no case study classes going on today. Okay, it's only corporate reporting. So if you've got the invitation for today to today's WebEx, you are indeed in the correct place. Matteo asks, have there been any changes to the open book since AA? Nope. Just use the same one. Okay, it'll serve the purpose more than necessary. I did have one more item on the materials checklist I need to mention. It's the self-test question book. So this is something that's on my Kaplan only. There's no hard copy available. If you went over to the study material section on my Kaplan, you'll see here you've got CR self-test questions. So in the past, the self-test questions used to be added at the end of each chapter to your study module. Now it is a separate booklet, and it just contains a series of questions on each of the chapters. You should be attempting these for homework or when you've gone through each study module phase or each chapter. Okay, so just a little bit of a note on that. Other changes to my Kaplan you may have noticed since you last attended a course with Kaplan are that there is the activity feed now available on the home page. so I'll just show you here. You went to the course home. This activity feed, it allows for students to make posts, and it allows for me to make posts which can be commented on, okay? So it mentions here in the notes, for me, I am able to send you messages, files, hyperlinks, and videos. You can download anything I share. You can also start a post or comment on another post. Just set up notifications within your MyCapLan settings, and then you should receive a notification every time something new is posted onto the activity feed. One thing I will also highlight to you is that on the activity feed, there are a series of pre-recorded live online lectures that we have included here. Now, these lectures will not correspond exactly to the material I cover on the course, but they are there as an extra resource for you if you wanted to recover some of the content. These are pre-recorded lectures from previous courses that had run online. Okay, so you've got 4 of them on your screen. I wouldn't necessarily use them as a first port of call. It is an extra resource for you, but they don't correspond exactly to what I'm going to cover on the day. So we are now at the advanced level. Congratulations all. Okay, the final hurdle before we complete our ICAW journey. So I believe we're doing all 3 subjects at the same time. We're going to be focusing, or at least for the next 2 days, focusing on corporate reporting. So CR is a 3.5-hour long exam. Okay, so it's a step up from the professional level. The exam, the CR and SPM are now 3.5 hours long. That means you should be spending about 2.1 minutes per mark, and the pass mark has now been reduced from 55 down to 50. 3.5 hours seems like a very long time, but I assure you the time will go by very, very quickly. So as with all of your exams with the ICAW, time management is crucial. Now, you will have to be registering for the exams yourself. Obviously, there's been a postponement with the registration, so wait to hear from your employer before you go about registering yourself. Just had another question. Is this being recorded? Yes, it is. This lecture is being recorded, although I cannot guarantee that the lecture will be uploaded immediately after it is filmed, so there may be a little bit of a delay. Please, can you direct your messages to all participants if you think that they will benefit? Okay, so happy to answer queries, but just, make sure everyone else can see on the chat panel. Beautiful. Now, as I said, wait to hear back from your employer and the PwC team about registration. Once registration sessions are open, make sure you book early so that you get your preferred center. Okay. Now, let me tell you a little bit about the case study exam itself. Okay, so you're going to get 3 questions. Okay, that's guaranteed, 3 questions. They'll be worth between 30 to 40 marks. What's generally the case, here, one of the questions is going to be the big 40 marker. It's a mini case style scenario involving an assurance engagement and financial reporting. Okay, so you may be in an audit context, maybe in an assurance context, and it'll be a mixed requirement. Indeed, corporate reporting is an integrated mixed topic exam. So they will be testing in quite some detail the very technical aspects of financial reporting, but quite often it may be in an audit context. So you happen to be the auditor in the scenario, or you happen to be the assurance provider. So part of the question could ask you for audit risks. Part of the question could ask you to explain the correct financial reporting treatment. You're going to get one big 40 marker. You'll get a shorter question, about 30 marks, which is pure FR, pure financial reporting. And so there, typically, you will have to explain the financial reporting treatment of a series of issues. Maybe you need to propose the correcting adjustments, propose the correcting journal entries. Maybe you even need to redraft some financial statements. So hopefully you're familiar with that style of question from back in FAR that explained the financial reporting treatment technique, that skill you still needed for corporate reporting. What they also may add to the requirement is a little bit of interpretation or some financial statement analysis. So you may be given some draft accounts where you need to do some calculations, calculate the movement since last year, maybe some ratio analysis, and interpret that data. Turn it into useful information and make some sensible comments on what you have observed. The last question is an integrated question yet again, so it'll be about 30 marks. It's going to be a combination of financial reporting and audit and assurance, but this requirement tends to be a little bit more audit heavy. Okay, again, it could be asking you for audit risks and procedures, could be asking you about controls, could be asking you about considerations to do with audit risk, to do with reporting, any aspect really that we've covered from back in the professional level. Now, the corporate reporting syllabus is broken down as follows on your screens. So 50 to 65% on compliance and analysis of financial statements. So when we talk about compliance, we're talking about the technical accounting rules. Okay, so do you know what they are? Do you know what the rules are? And can you apply them to various, sometimes complex scenarios? There'll be a bit of analysis of financial statements. As I said, you'll need to interpret some data. It could be draft financial statements. It could be other kind of numerical information. And quite often you need to do some analysis. Okay, do some ratios, do some movements. Recently, they've started even providing dashboards and graphs and other kind of infographics. So maybe you need to look at a pie chart or some kind of graph and interpret the data included there. Audit and assurance makes up about 30 to 40% of your exam. So it's nothing to scoff at. It is a significant part of this paper, of this syllabus, and the majority of the content you will have covered from back in the professional level. Everything you have covered is brought forward assumed knowledge for corporate reporting. We've got 5 to 10% going on ethics. Ethics features in every ICAW paper, and indeed it also features again in corporate reporting. Only this time the ethics is not going to be as clear-cut as you may have seen from previous papers. Okay, often the situation is going to be a little bit more gray. We're going to have to get some more information. Maybe there are hints, there are indications of some kind of ethical issue, but we really need to expand on it and identify on it. Okay, so the corporate reporting paper is going to be on the ICAW CBE software. We are all familiar with it now. We should all be familiar with it now already from our previous subjects. So you should all have the offline version downloaded onto your laptops. In due course, make sure you download the question bank as well. We, of course, can get all that from the ICAW website. So just log in with your credentials as a student, go to ACA Students, Exam Resources, click onto Corporate Reporting. And then, of course, you can access the 2020 questions in the practice exam software. So the second page of the PDF document will give you a link to all of the different questions. Each link corresponds to a different set of questions in the question bank. What I would like you to do at some point this week is download all of the zip files. Okay, and these correspond to all of the questions from the ICAW question bank. So every time you do some practice, you will be practicing it on the software. Now, corporate reporting is an open book exam. Okay, and so for a lot of you, this may be the first time you are sitting an open book exam. So just bear in mind that this is going to change the game a little bit. Okay, you can take any written or printed materials with you into the exam. So that's your study manual, your question book, your Kaplan workbook, any other handwritten notes that you have made throughout this course. So here's a list of things that students often take in. You may want to think or start quite early in thinking about an exam file. Okay, so don't be one of those students that comes into the exam hall with an entire suitcase, including every single piece of paper under the sun that you've accumulated since your certificate level accounting paper. You want to be smart about what you take in with you into the exam. So it may be worth starting to think early about setting up a kind of exam folder, maybe one or two ring-bound folders, which include the key points, the key parts of each chapter. Make sure you have it nicely organized. If you are doing any practice questions, or if you've got an example of a very technical requirement that you've written up, make sure it's very nice and neat. Make sure it's easy to read and understand, and everything's clearly labeled so you know where all the numbers have come from. Now, just because it's an open book exam doesn't make the paper any easier. It doesn't mean the requirements are going to be straightforward, because you can just jump back into your open book to get out all the relevant information that you need. Corporate reporting is very much an application-based exam. Okay, even though you've got all of your Kaplan notes with you, quite often the scenarios they come up with are going to be unique every time. So you can't just rely on a previous similar question. You do really need to apply all that technical knowledge to different exam style scenarios. Now, the more you take in, the harder it will be to find information. So as I said, don't be the one with the suitcase underneath your desk. Okay, you'll just be banging your head constantly, sticking your head underneath the table, trying to find that one piece of paper that might save you on the day. Okay, that isn't quite how it works, so just be organized. Have all your notes written up quite neatly. In the beginning, your exam file is probably going to be quite big, but as we go through the course, as you practice more questions and you feel more confident on certain areas, just start pulling away all the bits of paper that you didn't use, and stick with what's crucial, stick with what's key that you can access easily. Okay, so there was a little bit of pre-coursework to do before the course. I hope you all attempted the pre-coursework. There were a series of initial assessments that you needed to complete as well, which sort of tested your brought forward knowledge. Remember that all the information in the pre-coursework is assumed knowledge for the corporate reporting phase, okay, which is why it is compulsory. You should have set aside about 3 to 4 hours to do this. If you haven't done it, it's not too late. Okay, we're not going to be covering absolutely everything on day one. If you haven't done the pre-coursework, do make time to have a go at it, because there'll be content in there that we won't have time to cover in class, unfortunately, but it is still assumed knowledge for the course. Okay, now onboarding is for 2 days. Okay, so you will have me for Monday and Tuesday. For the rest of the week, you're going to have your tutors for case study and for strategic business management. And then after that, you will be starting your self-managed learning, so your SML course. During that time, you will be walking through the triathlon sportswear case studies. Okay, remember that's the extra booklet that you receive with extra exercises to do during your SML. Okay, so that'll be an opportunity for you to apply your knowledge to corporate reporting style scenarios. So just had a question here from William. Do you know which days we have the case study and SPM? So I would follow the links that you received for the WebEx invitations. I have a feeling you have case study on. I don't want to say, okay, check with your course booking spreadsheet and wait to hear from WebEx. Wait to hear from the invitations you receive. Okay? Right then. So expectations for onboarding. So attend promptly, okay, at 9 a.m. just like you would at work. We've got 90 attendees, so I'm hoping that means that is the majority of the class. Registers will be taken. Registers will be taken. So make sure that when you log on, I did send an email about this the other day, make sure that you log on and put your correct name in exactly as it appears on my Kaplan, because otherwise, you know, if you put some kind of nickname, then it may not be recognized on the register and your attendance will not be recorded. John and Rob, my beautiful teaching assistants, will be taking the register. They'll probably check kind of around about now up until 10 a.m. who is in the attendees list and mark you as absent or present. Okay, so attendance is expected. It is mandatory for all of these live online sessions. Okay. So the college days are compulsory. If you expect to be absent for any of the days, can you please let me know and inform your employer, inform your professional qualifications team, and copy in the PwC team as well. I've just got a private message on the chat panel. Is Wednesday also onboarding? So just to clarify, class, this entire week is onboarding. Because you are doing 3 subjects at the same time, you will have onboarding for corporate reporting, you will have onboarding for SPM, and onboarding for case study. So just going through the chat panel, it looks like you are going to have strategic business management on Wednesday. So your tutor will go through all of the key aspects of SPM on Wednesday, and then I think your tutor Anne will go through case study on the Thursday, Friday. Try to keep distractions away. Okay, so there will be plenty of breaks. We have 2 in the morning, an hour for lunch, and a break in the afternoon. Throughout the SML phase, you are expected to complete all of the exercises, all of the homework set, as well as the interim assessments and mocks. Okay, so there are some assessments for you to complete. At the end of SML, there will be an interim assessment. It's like 60% of a full corporate reporting exam. I'm going to talk a bit more about that at the end of tomorrow, so you'll get more information on that then. There is, of course, another mock exam as well to sit, but that'll be later on in the course during SGS week. Ask any questions. So there's me on the chat panel. There's John. There is Rob. Okay, they're there to help you out. Last bit on the intro slides is just a little bit on well-being. So for a lot of us, possibly all of us, this is the first time we are attending lectures online via a live online course. So it is a little bit different to the classroom, not like what we're used to. You know, we are staring at the screen the whole day. Make sure you're taking loads of breaks. Make sure when I set a break, you stand up, you have a stretch, you stick your head out the window, get yourself a cup of tea, stay hydrated. You know, so you're looking after yourself throughout the course. And then just zooming out a little bit on a broader scale throughout the whole phase of studying for the advanced level. Okay, make sure that you seek out help if you need anything, okay, from your colleagues, from your friends, from your family. If you need any sort of extra support, any kind of maybe pastoral support, contact our academic support team, get in touch with me if you need any help specifically with the topics. You may or may not be aware that the ICAW does have a charity dedicated to ICAW students and members, which is called CABA. So I just want to highlight that to you so you are aware of that organization as well, being someone you can get in touch with. So those were the slides I wanted to cover for the start of the day. Just had a question from Edward, which I think is relevant for everybody. Is there an update on when the exams will be and or when we can register for the exam? So my understanding is that the exams have been delayed. I don't know specifically what the dates are yet. You will hear as soon as exam registration opens from your employer. So I would just look out. I would keep my eyes peeled for that message. Okie doke. Beautiful. So, oh, is it official? Great. So I did hear the exams were at the last week of August. Wasn't sure if that was official yet or available to all students. So that is good stuff. The exam prep phase of the course will likely be delayed, will be pushed back to a couple of weeks before your exam, but now you've got August as your deadline, okay? So the goalpost's been pushed back a little bit from July to August. All right then, so here is our plan for today. Okay, so you need to have your Kaplan workbooks open in front of you. Here we're going to go through chapters 1 and 2 in total. Chapter 1 is fairly short, an introduction to corporate reporting as an exam in general. Chapter 2 is partly revision. Okay, so probably half of the chapter will be things you have seen from back during your FAR days. And then we will be covering some new areas as well, all in relation to group financial statements or consolidated accounts. I want to break the back of chapter 3. So we'll probably get a few sections, maybe one section into reporting overseas transactions. The more we can clear out of the way today, the better. Okay, that means, you know, we can go straight into the sort of heavyweight sections of the chapter tomorrow morning. Okay. Our plan for today's morning session was to introduce ourselves to the course, so I can tick that off my list. We're going to open up, we're going to take a look at chapter 1 and maybe start chapter 2, maybe get through the first 1 or 2 sessions. So can I ask you all then to please open up your Kaplan workbooks, whether that be on a tablet of some kind, up on your screens, or on a printed sheet. And let's introduce ourselves to corporate reporting. Okay, so may I remind you all that we are, you know, everything, that this is an open book exam. You can take anything in with you, so make all of your notes nice and legible and beautiful and neat, so you want to refer back to them, so it's easy to find all the information you need for the real exam sitting. Okay. So in an introduction to corporate reporting, okay, we'll just remind you of the key financial statements, okay, that are included in a complete set of accounts. We'll talk briefly about the financial reporting requirements, and I'll just remind you again quite briefly about all the various accounting concepts, okay, about the various sort of characteristics that financial statements need to have, okay, in line with the standards. So scrolling along to the next page. First of all, what is corporate reporting? Well, when we talk about corporate reporting, it's not just what's in the financial statements, but it is also any other external reporting, such as audit reports and environmental reports. So it's pretty much anything that's included in the annual report. Okay? The financial statements are usually at the back of the annual report. Okay, you've got the P&L, the SFP, the SOCI, the additional notes. Those are the financial statements, but the annual report includes the front half. It includes all the other stuff. Okay? So, such as audit reports, such as any other kind of, you know, reporting to the shareholders, reporting to the users. So, corporate reporting is a mixed or integrated paper. Okay, so it is going to be examining you on both the technical aspects of financial reporting as well as any audit and assurance considerations. Okay, so the paper will ask you to apply a series of things. Okay, there is of course a series of technical knowledge you're required, but remember this is an open book paper. Okay, this is an open book exam, so all the technical knowledge you need in some form or another will be in your open book. You'll see that the majority of marks go more towards the application skills that you need. I've just received a question privately. So will this WebEx be recorded and available to us? This WebEx will be recorded, yes indeed, although I'm not sure exactly when it will be uploaded to my Kaplan. There may be a little bit of a delay there. Can I just ask, if you want to send a private message, please could you direct it to Rob or John? If you send it to me privately, then I might not be able to pick it up in time. I may not get a chance to reply. So if you want to send a private message, if you could please direct it to John Sharrett or Rob Zeffert on the chat panel, then I would be ever so grateful. Thank you. Okay. You'll see that there are a lot of analytical techniques that are required. Okay, so that is going to be some kind of financial statement analysis. As I said, we need to calculate ratios, movements, and do some kind of interpretation from that. There will be a series of professional skills as well. Okay, so what we mean by that is basically learning to use your judgment, okay? Because part of the exam involves going through a large series of exhibits, a large bulk of information, and dealing with the key aspects, what's important to the question, and leaving out all the peripheral, less important stuff. I'll show you a demonstration of what I mean. So what I have done on the screen is pull up a question from the ICAW question bank. Okay, let's pull up a past exam question. So here we go. We've got July 2018. Okay. So for this past paper, you can see that unlike what we saw previously with the professional level, there are now two buttons. Okay, so press the question button. You've got one page with a little bit of background information. It's a 40 marker, so you can see the requirement is to respond to Gaynor's instructions, and you then have to dig into the background information to see all the various sub-requirements. And that is 40 marks each. Now, as well as the question, you are going to have a series of exhibits that are made available to you, and the number of exhibits can vary. Okay, we usually have some text giving background information on what happened during the year. You're going to have some numerical information. Okay, you can see here we've been given breakdowns of various other bits of data, some additional notes. So a lot of the professional skills required are basically being able to sift through large swathes of data and pulling out what is important and writing about that within the time available. Okay. Quite often with the exam, you may be asked about the financial reporting treatment of various issues. You need to be able to identify, explain, and evaluate alternatives to determine the appropriate solution to compliance issues. Okay, so what that means, remember that certain accounting standards allow an entity the choice of how to deal with a certain issue. Think about PPE. We've got the choice of the cost model versus the revaluation model. Think of inventory. We've got the choice of whether to apply FIFO versus LIFO. Okay, so maybe you need to talk about the options. Okay, maybe you need to talk about the possibilities available to an entity, and maybe you need to evaluate them. Maybe you need to suggest, what would be suitable, or maybe you need to describe the impact on the financial statement of adopting a particular accounting policy. Okay, so that's a new level skill we're seeing in advance that we haven't seen from back in the professional level. Now, you are expected to have some kind of awareness, some kind of understanding of the commercial context of an entity. Okay, so in other words, think about for any new business decision, for the implementation of any accounting standard, you need to think about the impact that standard may have on the profits of a company. you need to think about the impact that accounting standard may have on the position of a company, right? So that's showing an understanding of how certain accounting policies, how certain transactions and events can impact the financial statement, impact the profit or the net asset figure. Now, let's skip on a few sections. Okay, so the relevant standard here that we're going to be looking at is, of course, IFRS. All right, so that is the set of standards we'll be examined on. Bearing in mind, some of you, if you work in audit, then you may have come across UK GAAP. Okay, if you are auditing UK clients, then maybe they are applying FRS 102, which is the most common set of standards for companies based in the UK and Ireland. So, okay, that's a separate set of accounting standards. We find that as time goes by, there are fewer and fewer similarities between UK GAAP and, there are fewer and fewer differences between UK GAAP and IFRS. There still remain some differences, however, okay? So you may remember them from when you did the professional level for FAR. You were examined a little bit on UK GAAP, IFRS differences, not for corporate reporting, okay? The standard we are looking at will be IFRS. And all of the materials are prepared in accordance with IFRS. Okay, so we're going to breeze through this chapter. Just going to, most of it is sort of brought forward knowledge. Just want to remind you of a few key aspects about corporate reporting. So when we talk about the objective of financial statements, it is to provide information to the users of the financial statements on the performance and position of an entity. The potential users of a company are listed on the screen. The most important users are, of course, your shareholders. Okay, so they've been sort of labeled as potential or existing investors. Okay, they're your shareholders. They're the ones most interested because, of course, they're the ones that own the company. They're the ones that have an entitlement to any profits made by the company. Bear in mind, we do have other users to the accounts, employers, lenders, suppliers, etc. You are expected to have an understanding of why these users are interested in the financial statements and what in particular they may be focusing on. So when it comes to the lenders, for example, okay, the entities that lend a company money, they're going to be interested in, say, the cash flow of the company. They'll be interested in the interest cover of the company. They'll be interested in, whether the company has sufficient net assets. They'll be interested in whether the company is in line with any covenants that have been imposed by the lending or by the loan agreement. Okay. Now, in the exam, this is all about having a little bit of a broader understanding, okay, of the general users. It may be the case you need to provide a report for one of these users, and you need to understand what they are interested in, what they will be focusing on. If we look at the various components of your financial statement, okay, this is all of the key financial statements we need plus the additional notes. So we've got your statement of financial position as at a particular date. Remember that the SFP is a snapshot at a particular point in time of what the value of the assets of a company were and what was the value of equity and your liabilities. Okay, so the statement of financial position is really an expansion of that accounting equation we know and love from back in your certificate level. We have your statement of profit or loss and other comprehensive income. Okay, so you'll find that the big step up from the professional level to the advanced level is that now we are going to see many more items appear as part of your other comprehensive income. Can anyone remember, what did you see in the past from the professional level? What kind of transaction did we see being reflected in other comprehensive income? Revaluations, brilliant. Thank you, Rafi. You are indeed correct. We saw revaluation gains on property, plant, and equipment. Okay, so that went into other comprehensive income. And that was the only thing we've seen from FAR. In corporate reporting, you're going to see all this new stuff, all these other kind of gains, okay, that we can post through OCI. I've just had a question on the chat panel. Would it be possible to get the annotated workbook chapters at the end of the day? Yes, I'm happy to share my notes with you. I'll post them at the end of the day. I'll put them in the My Update section on my Kaplan. Okay, so that's the My Update section on my Kaplan. We've got your statement of changes in equity. Okay, so that reconciles all the opening balances for your share cap, retained earnings, revaluation reserve, and any other capital balances. It reconciles the balances from the start of the year to the end of the year. This is, of course, what the owners of the company are most interested in because, of course, it's the equity that is owned by the owners, by the shareholders. You've got your statement of cash flows. It's not as common for corporate reporting as you may have seen for FAR, but it does still come up. Okay, we did see statement of cash flows appear in one of the 2019 papers. So, as I said, everything from FAR is assumed knowledge. And then we have the additional notes, of course. So let's remind ourselves about what our statements look like. Here is our standard pro forma for the statement of profit or loss. In the exam, you may be asked to prepare from scratch, or more likely, you may be asked to redraft some financial statements. So quite likely you'll have to have several columns, one for all your line items, one column for the draft figures, and then several subsequent columns for each and every adjustment as you deal with the additional information. Okay? So typically, you might have to redraft some financial statements with adjustments. Furthermore, you may need to do some financial statement analysis. Okay, what's the gross profit margin? What's the interest cover? What's the operating margin? Okay, so, you know, doing these kind of calculations you learned from back in audit and assurance, but also saying something meaningful about it. Okay, so you don't get, sadly, the exam is a little bit more strict, a little bit more harsh with corporate reporting. You don't get marks in and of itself just for doing the calculation. You need to do a calculation and say something sensible about it. Okay? And that's what the examiner will give you credit for. Applying that skill of application, of knowledge about interpreting information and making a judgment from it. So here we've got our typical pro forma for the statement of profit or loss. Going to the next page, we have our statement of comprehensive income. So let's remind ourselves what the statement of comprehensive income is. It is a mini statement that we add on usually below your statement of profit or loss, where we reflect profit for the year. That's the bottom line from your P&L. And then we add all items of other comprehensive income. So the gain on property revaluation, we of course saw from back in the FAR days. Everything else in this list is new to corporate reporting. Okay, so I won't go through each and every item on the list. Don't want to scare anybody. You will understand what they are as and when we go through the course. One thing I will highlight is that in terms of the items which have been listed as part of other comprehensive income, they have been split into items that will not be reclassified to the profit and loss, and items that may be reclassified subsequently into the profit or loss. What on earth does that mean? Well, for example, with gains on property revaluation, what we're saying is that if you have built up any gains in the revaluation surplus, that stays there. It'll always remain within equity. We will never see that flushed out and recognized as income in the statement of profit or loss. Okay? And that's the same with all of these other items. When the actual item materializes, when the item realizes into cash or is removed or realized or whatever from the account, the balance that has been built up in equity stays in equity. Okay? We don't see this recycling, we call it. We don't see this recycling or flushing out into the statement of profit or loss again. Conversely, for the three items below, items that may be reclassified subsequently to the statement of profit or loss, that is where, any gains or losses is built up within equity when the thing we're looking at, okay, when the item that we're looking at is finally sold or the transaction actually materializes, then any balance built up in reserves gets flushed or recycled, as we say, into the statement of profit or loss. So add profit for the year plus OCI, and that gives you your total comprehensive income for the year. Okay, so scrolling over then, we have our pro forma for the statement of changes in equity. Think of this like the equity section from your statement of financial position, but we're going to rotate it 90 degrees, and then we're going to show everything that happened from the start of the year to the end of the year. The first four columns should be familiar to you from previous sittings from FAR. You'll see that we now have this extra column for other reserves. Okay, so this is going to be new for corporate reporting, and that other reserve is going to relate to any of the items we saw in the previous list. So one of the things we're going to look at are gains on translation of foreign operations. So we'll see that tomorrow. That is where one company comes along and buys another company from a different country. Okay, and so one company may be reporting in pounds, the other company may be reporting in dollars. Well, we're going to have to translate all the results of the company in dollars to pounds before we can consolidate. So one item that we reflect in OCI is any gains and losses on the translation of any foreign operations. That's going to have its own reserves column within equity. Okay, we're going to have financial assets classified as fair value through OCI. We're going to have cash flow hedges. They all get their own reserves columns. Don't worry if you don't know what they mean yet. You will do later. We'll consider them in later chapters. So don't be alarmed by anything you see for the minute. It'll all make sense in due course. Say hello to our good old friends, the Statement of Financial Position. We know and love this statement very much. You would have prepared many statements from back in your FAR days. There's no real big change. Okay, so we've got our assets at the top. Show your non-current assets first. PPE, investments and intangibles, which include goodwill. We then have our current assets. Okay, inventory, trade and other receivables, cash and cash equivalents. We've got non-current assets held for sale. Remember that one from FAR? Okay, that is all governed by IFRS 5. That's when you plan on getting rid of an asset. Maybe you're going to get rid of some PPE. So you stop using it in the business, you stop depreciating it, you move it out of non-current, and you put it at the bottom of your non-current asset. Okay, that's called a non-current asset held for sale. The examiner quite likes this one. Okay, IFRS 5, non-current assets held for sale, quite popular with the examiner. Okay, it was examined in FAR, it gets examined again in corporate reporting. So this will give you your total assets, that's the total value of the company, which we of course are going to allocate to its equity and its equity holders and its debt holders. Okay, in other words, okay, we break down that value between the equity and the liability balances. So within equity, we've got our capital and reserves. Okay, your capital balances will be your share cap, share premium, and any other kind of irredeemable preference share capital. We then have the reserves of a company. That is your retained earnings, your accumulated profits less accumulated losses, your reval surplus, and now other reserves Okay, that's all the new stuff for corporate reporting that we are going to learn about in some depth here. That gives you your total equity. Add up your non-current liabilities, add up your current liabilities to give you your total equity and liabilities. And of course, this value here must equal your total assets. A little bit of a tip for you in the exam: if you are asked to do a SFP of any type, whatever figure you get for total assets, just put that same number as part of your total equity and liabilities. Okay, it'll make you feel better. For those perfectionists in the room or in the virtual room, just make sure that make sure the numbers agree. Don't bother adding them up, because if they don't, you won't be able to let it go. You'll keep sticking to that question and not moving on to lower hanging fruit, from easier requirements farther down the exam. Just had a question from Ty. Shouldn't the pro forma balance sheet be in order of liquidity? So I presume you're talking about your current assets, Ty. Generally speaking, yes. When we talk about our current assets, they will be in order of liquidity from inventories down to cash. So you're going from least liquid down to most liquid. Okay, and cash is, of course, as liquid as they can be. Non-current assets held for sale is always reflected right at the bottom, so it's kind of separate to your current assets. So even though it may not be the most liquid, we still put it at the bottom of your current assets list. Your statement of cash flows is still examinable. As I said, it is, but then it did come up in one of the 2019 papers. Will you be asked to prepare an entire statement of cash flows from scratch? I mean, anything is possible. The examiner does have a carte blanche, but it doesn't tend to be the case. Okay, it's not what I have seen. It's not what I have seen from previous papers. Let's remind ourselves of the statement of cash flows, though, and what it presents, what it achieves. So your statement of cash flows is exactly as it sounds. It shows all the cash inflows and outflows of a company throughout the accounting period. So it's a dynamic statement showing all the ins and outs from the beginning to the end of the year. Your statement of cash flows is broken down into three distinct sections. We've got your cash flows from operating activities, first of all, or your CFO, as I like to call them, and that reflects, first of all, your cash generated from operations. So your cash generated from operations usually requires an additional working. You may remember that reconciliation we had to do. That reconciliation of profit before tax to cash generated from operations. It's where we take the profit before tax figure from the P&L and then strip out any non-cash items. So things like depreciation, it's a non-cash item. It reduces your profit, but it does not reduce your cash. So we add it back in the reconciliation. Okay, and those are the kind of adjustments we did to the rec, arriving at what I call informally as the cash profit. We knock off interest and taxes paid because they are, of course, typical operating cash flows, and that will give you the cash flows from operating activities. So we show a little bit of a subtotal indented to your right. We then show any and all cash flows from investing activities. So that could be in relation to the purchase of PPE, intangibles, or indeed any other kind of investment. Okay, so this isn't an exhaustive pro forma, it's just, a example. So any purchase or sale of PPE, intangibles, or investments, they are part of your investing cash flows. Okay, it shows how if the company is investing in growth, how it's deploying any significant cash balances. And quite often that will result in a net cash outflow. Okay, if you're buying new technology, if you're buying new machinery or plants, that's generally overall going to be a cash outflow, but it is an indication that the business is looking to the future, looking to grow and hopefully gaining some economic benefits from that in the future. You've got interest and dividends received from investments, so it could be dividends received on an investment in shares. It could be interest received from an investment in a loan note or a kind of bond. Okay, so they form part of your investing cash flows, reflect them as an inflow. We then have cash flows from our financing activities. So these are any cash flows between the business, between the company and its sources of finance, being either the shareholders or the debt holders. So if the company is borrowing or if the company is receiving extra funds from the shareholders, then that will of course be via the proceeds of shares. Okay, so we can have a rights issue, we can have an ordinary share issue, whereby we issue more shares and get further funding, further cash in from the shareholders. Or if we don't want to get more funding from the shareholders, maybe we can ask for money from the lenders, maybe approach a bank or any other kind of lender and issue a financial liability of some sort. Okay, that would lead to the issue of a loan, which is a cash inflow. Conversely, we could be repaying a loan that we had taken from previous years, and that would be a repayment. Any dividends paid, of course, dividends paid to shareholders, and they are recognized as a financing activity. Okay, we would show that as a deduction and overall get our net cash used from financing activities, indent that as a subtotal to the right, top up your subtotals from top to bottom, and your overall net movement in cash for the period should be the same as the movement between your cash and cash equivalents at the beginning of the year and at the end of the year. So the difference between your brought forward and your carried forward cash. Okay. That's what the statement of cash flows is. It shows how a cash is being used within a company, how it's being deployed. It's laid out into operating, investing, and financing cash flows. And it is very useful for the users. It's a very useful financial statement because, of course, cash can't be manipulated. Okay? There are no accounting estimates involved with cash. Cash is cash. It's easy to understand. It's very factual. Okay? It is not subject to manipulation like that profit figure. Okay. Moving on. Do you remember the conceptual framework, the IASB conceptual framework? Okay, so we did cover this from earlier studies. It covers the objectives and the general purpose of financial reporting. Okay, it states, remember, that all financial statements should have the two fundamental characteristics of relevance and faithful representation. So when we talk about relevance, we're really talking about material information that can impact the economic decisions made by the users of the financial statements. Okay, so that is how one determines whether information is relevant or not to the financial statement, whether it's inclusion, or its omission would impact the economic decisions of the users. This is, of course, judgmental, okay? So it's judgmental as part of the, from the entity's point of view, what the directors decide to include in the financial statements or not. It is subjective from the auditor's point of view as well. Okay, so relevant information must be included in the accounts, and that information must be faithfully represented. So when we talk about faithful representation, we're really talking about whether the information is true and fair, we can say. True and fair, free from bias, free from subjectivity, free from kind of management's own agenda. we have various enhancing characteristics. So as well as the two fundamental ones, we say that financial statements should also be comparable from the prior year to the current year, from one company to another company. They should be comparable, so that means that they need to be prepared under a like-for-like basis. And indeed, that's the reason why we have a set of standards that businesses should follow. The information should be verifiable, which means it can undergo an audit and have a sufficient audit trail to provide appropriate evidence for the auditors. The information should be produced on a timely basis. So accounts need to be published within 6 months for listed entities, between 9 months for unlisted entities from the reporting year end, and accounts need to be understandable. We generally assume that entities are going concerns, and therefore the financial statements are prepared under the going concern basis. The going concern status of a company needs to be assessed at the end of each year for a period of 12 months from the reporting date. Okay? Now, I think we are living in a very interesting time at the minute. Okay, I'm sure everyone has been reading the news. They've been seeing a lot of airlines, a lot of retailers, a lot of restaurants, pubs, entities in the service industries have been suffering quite significantly as a result of the recent lockdown measures by the government. So I would be very fascinated. I would be very interested to see published annual reports at the end of this year. Okay, I think there will be a lot of consideration on this assumption. Okay, and I reckon, there'll be a lot of disclosures on this. Indeed, if there are any uncertainties relating to going concern, they of course need to be disclosed in the financial statements. If the company is not a going concern, then the breakup basis needs to be applied to financial statements. Okay, so I think we're living in a very interesting time. I'd be very interested to see what all these entities, how all these entities prepare their financial statements. So, back to the text. The underlying assumption is that financial statements are prepared under the going concern basis. If there are any uncertainties, they must be disclosed. If the company is not a going concern, then of course we must apply the breakup basis. Okay. Beautiful. Remember the key elements of your financial statements. So we have your assets, liability, and equity, which form your statement of financial position. We've got the income and expenses, which form your statement of profit or loss. Okay? All right, let's scroll forward to the role of auditing. Can I just check in the room? What part of PwC do you work in? So are you an auditor? Do you work in tax? Do you work in any other department within your firm? Auditor. Okay, a couple of tax. Auditor, BCM. Tax, audit. Okay, so looks like the overwhelming majority are auditors, but we do have a few tax accountants in the house. Okay, so no worries at all if you are not in audit, but this is an integrated paper, so for some of you, maybe you can rely on some of your auditing experience. Maybe you'll feel this exam comes to life a little bit more because you can relate it to your real work. We've got a member from Deals as well, so we've got quite a broad mix. For those that aren't in audit, just to remind you, okay, the whole purpose of an audit is to enhance the degree of confidence that the users have in the financial statements. So the idea is that a company prepares its annual report and its financial statements. The auditors then come along. They are an independent third party of experts that review the financial statements, that audit it, and obtain sufficient and appropriate evidence that the financial statements are free from material misstatements. Okay, so that is all stuff from back in your Audit and Assurance Papers 101. Okay, so you've got a list of kind of the benefits of an audit. It enhances credibility. It could be a fraud deterrent. Okay, it promotes discipline over maintaining accounts and so on. I'll leave that for you to read in your own time. But essentially, you know, the whole point of an audit is to give confidence, to give assurance to the users that the information they read in the accounts can be trusted. The whole audit process is going to be covered in detail in a later chapter. Okay, so in one chapter, you'll basically be experiencing a whirlwind reminder of everything you covered from the professional level. But let's just remind ourselves about that whole audit process. Okay, audit is, you know, and a lot of you will know because you are in audit, audit is very cyclical in nature. Okay, so, you know, you get to your audit planning, you start doing all of your sort of background checks on the client, your KYC, your planning documents. You do the testing, you evaluate the results, you work really hard to get that audit report signed, and then it's like Groundhog Day because you just get back to the start and plan for the next year's audit. So it's very cyclical. The audit process is listed below. So the start of the audit process is your client acceptance and continuance. Okay, so first of all, do we take on a brand new audit client or not? Okay. Are there any issues we should consider before we take on a new audit client? For example, and I have this little mnemonic I always use called LERP. Are there any legal issues that would stop us from taking on a new client? Okay, and was due process not followed with regards to the removal of the previous auditor, say? Are there any ethical issues? Okay, are there any conflicts of interest that would prevent us from taking on the client? Maybe we audit one of their competitors. Are there any issues in terms of resources? Okay, are there issues in terms of risk? Okay, can we take on the level of risk associated with this client? Do we have the right expertise? Do we want to be associated with this particular entity? And are there any practical considerations? So do we have the right staff? Are the staff located in the right locations? And so on and so on. We go on to planning the audit. Okay, so planning the audit means understanding your entity, understanding the key financial reporting processes involved with this entity, identifying any risks and audit procedures. Okay, so what areas of the financial statements are most susceptible to misstatements, and what is the auditor going to do about it? That's your risks and procedures bit. That's quite a common requirement in corporate reporting. The examiner loves asking you for risks and procedures. You quite often need to do a preliminary analytical review. Okay, and that may be part of identifying any audit risks at the planning stage. Okay, so identify, has gross profit moved in a direction not consistent with the background info? Has the interest cover gone down to an alarmingly low rate? How's the net assets figure? How's the cash balance? Okay, so, you know, we might analyze all of these draft figures to identify potential audit risks. We go about performing the actual audit, okay, and that is going to be is working. Uh-oh, sound has gone. Is that just one person or is that everyone? Oh, it's back. Some had audio issues, it's back. Okay, good stuff. I think that does happen, guys, so, you know, bear with the process a little bit. It does take, the sound can go off and on, usually just refreshing the audio connection or the audio broadcast tends to do the trick. As we were saying, with performing the audit, when we talk about tests of controls, it's the auditor testing how well a particular process is operating. Okay? So, for example, how if a computer is using some kind of automated system, how effectively does that system calculate the depreciation charge for the year? How effectively does that system calculate how much income should be deferred and how much income should be recognized in the P&L? So we're testing the actual controls around recording financial transactions and information. Substantive procedures, on the other hand, is getting to the nitty-gritty. It's about testing the actual numbers. It's about testing the disclosures in the financial statements. And this can be done through tests of detail. It can be done through analytical procedures. And by that we mean developing an expectation. So instead of calculating the depreciation for a sample of assets from the entire fixed assets register, how about you do a proof in total calculation? Let's try to estimate what the total depreciation charge would be for the entire year and compare it to the client's records. Okay, that's the kind of analytical procedure. You're developing an expectation of what you think the result should be based on sound data, based on reliable underlying evidence, and then comparing it to the client's actual results. We evaluate the results of all of our work, okay, and we do all of our other concluding procedures, concluding steps, and this involves assessing the going concern status of a company, identifying any subsequent events, related parties, any other kind of disclosures, and so on. We then have the final audit report to issue. We can, of course, have a modified report, and then we've got a series of modified opinions that the auditor may issue. So, as I said, all of these aspects would be covered in detail later on in the Kaplan workbook. Now, who requires an audit? All companies require an audit unless they qualify as small. To qualify as a small company, they must meet at least 2 of the following 3 criteria. Okay, so you can read that in your own time. Now, let's just have a little bit of exam focus whilst we are on this page. So, the audit and assurance syllabus is quite broad. How can you be examined on this for your corporate reporting paper? Well, let me tell you about the most common types of requirements we see. You may be asked, and this is the most common one, you may be asked to identify audit risks and audit procedures. When we talk about audit risks, remember that they can be broken down into 3 types of risks. We've got inherent, control, and detection risk. Inherent risk is where a particular transaction or balance is just complex by its very nature. Okay, maybe it involves an accounting estimate. Maybe it's very subjective, and therefore it is just inherently susceptible to misstatement, and it's difficult to be controlled for. On the other hand, a control risk is the risk that we have misstatements in the financial statements because the client has poor procedures in place. Okay, maybe the client Maybe there has been an instance, with where a particular process or a particular system isn't working adequately. Okay, well, that would be a control failure. That would be the responsibility of the client. The detection risk is the risk that the auditor fails to spot a misstatement, either because they didn't do enough work, because of a sampling error, because of a sampling issue. Okay, maybe they sampled the item that didn't have a misstatement in it, but they didn't sample the item that did. Maybe it's because the auditor had sent inexperienced staff in to do the work. So that's a common requirement. Identify audit risks and procedures. You may be asked to suggest tests of control. Or substantive procedures. You may be asked to find any weaknesses in existing audit procedures. And this is the kind of requirement that will be brand new to you for corporate reporting. So in a typical exam style scenario, you may be the audit senior, okay, and you have been asked to review the work that has been completed by an audit junior. Well, quite often that work completed will be incomplete. Okay, it will have drawn some incorrect conclusions. It will have not explored or done all the required audit procedures and tests. And it is part of your job to evaluate and identify any weaknesses in the procedures that have already been done. So in this kind of requirement, you are actually critiquing your colleague, you are critiquing your fellow auditor, not the actual results of the client. Okay, so that's a new kind of skill. It's where you need to identify where a procedure has either been done incorrectly or incompletely. Okay, so that's a new skill, a kind of new advanced level type thing you need to demonstrate for your paper. We find weaknesses in existing audit procedures, and quite often you will then have to identify any additional information required. You will also quite likely have an issue or a requirement about ethics. All right. Remember that in terms of auditing regulation, the auditing body, all UK auditors are governed by your international standards on auditing. That's your ISAs. That is going to be basically your open book. Now, as I advised, if you've already tabbed up your open book from when you did audit and assurance, then just use that version, okay? There's no point tabbing up the new book because it's just a lot fatter. Doesn't mean there's more content in it. It just means that the pages are now thicker. Okay, I don't know why the ICAW have started to print on thicker pages. It just makes the book a lot more heavy and twice as big. So if you've already got your old version tabbed up nicely and neatly with beautiful colors and highlighters, then use that one, please. Okay. So we've got the international standards on auditing that UK auditors must follow. There are also certain requirements as per the Companies Act 2006. Remember, per the Companies Act 2006, the auditors need to identify any inconsistencies between the financial statements and the director's report. The auditors need to report by exception if they didn't receive all information required for the audit. Okay, so this was quite a whirlwind tour and a bit of a reminder through audit. It is all in your open book. You will be analyzing this in detail for the subsequent in your subsequent modules, in your subsequent chapters. Okie doke. So let's tick the introduction to corporate reporting off our list. It's 10:35. I think we have just about long enough to break the back of chapter 2. I just want to remind you a little bit about group accounts. We'll then take a 20-minute break and get into the nitty-gritty. So please, could you open up your workbooks to chapter 2, please? Okay, so you can see here this chapter is called Revision and Update. That basically means we are going to have some stuff we've seen from in the past in FAR, and we're going to have some new knowledge that we're going to learn for corporate reporting. So let's jump into the overview. In terms of the revision, we are going to remind ourselves of all of the different types of investments. Okay? So one company can come along and buy shares in another company. We call that an investment. That investment can be classified as a series of things. Okay? It could be an ordinary trade investment. It could be a subsidiary. It could be an associate. It could be a joint venture. It all depends on things like how many shares the parent owns. It depends on how much control the parent is able to exert onto the investee company. Okay? So we're going to be recapping those different kinds of investments, and we'll be recapping how we prepare consolidated financial statements. So that's the consolidated SFP and the consolidated P&L. That's all the revision stuff. We're then going to look at new things for corporate reporting, on acquisitions and disposals, but in particular, we're looking at what we call step acquisitions. So you've seen in the past how we deal with where a parent buys a brand new investment. What about where the parent buys shares in a subsidiary in stages? Okay, so it is slowly achieving control. What if, say, the investor had a 30% stake in an entity, but then acquired an extra 30% of the shares, so now has 60%? Well, can you see that based just on shareholding, we've gone from an associate to a subsidiary? Okay, we've achieved control. So we're going to learn how to account for that. We're going to see what happens when there is no change in control. So let's say I had 80% of the shares, and I've now got 90% of the shares. I had a subsidiary before, and I still have a subsidiary now. What happens if we achieve significant influence? So let's say we initially started off with an ordinary trade investment. We bought an extra 20% of the shares and have gone up to 30%. We'll look at what happens with a full disposal, and that is revision from back in FAR. We're going to look at how to account for partial disposals, and that is all new for corporate reporting. So what happens when we go from a subsidiary to a smaller subsidiary? For example, let's say we're going from 80% to 65%. What happens if we go from a subsidiary to a sub? Let's say 80 to 40. What happens if we go from a subsidiary to an investment? Or an associate to an investment? So that's our objective for this chapter. That's what I plan on getting through today. Okay, so I think we will have time probably to just go through section 1 of our workbook. So let's talk about all the different types of investments, okay, all the different classifications. So when a company comes along and buys shares in another entity, we need to classify that investment as any of the following. So I'm just going to turn off my screen so I can write on OneNote. If the parent entity has achieved control of the underlying entity, then we call that entity a subsidiary, which therefore must be consolidated. Now, from back in FAR, you learned that if we had greater than 50% of the shares, we control that sub, okay? So in a very simple sense, we can say control is where you've got greater than 50%. We'll notice, or we'll see in a little bit, that actually the idea of control is a little bit more complicated. If we only achieve significant influence, then we treat the entity as an associate, which means we do something called equity accounting for that associate. Equity accounting is where we include that one extra line in our SFP. We call it the investment in the associate, okay? And there's a special working to calculate that figure. Now, how do we know if a parent entity has significant influence or not over the underlying company? Well, from back in FAR, you learned that significant influence was generally achieved if the shareholding was between 20 to 50%. Let me just write that a little bit more neatly. Between 20 to 50%. Okay, so that was your kind of bright line criteria. You'll see again, significant influence is a little bit more complicated than that. It could be that we have an investment in a joint venture. Okay, a joint venture. And if we have an investment in a joint venture, then the accounting treatment is the same. We do some equity accounting. So we have an investment in the joint venture. An entity is considered a joint venture when the investors have joint control over that underlying company. So the keywords you should be looking out for in an exam, the key descriptions, are where the company has, or where the investors, have what we call unanimous consent over the key operating decision. Unanimous consent over the key operating decisions. So that means everyone needs to agree on any new purchase of an asset, on any new taking out of a loan, etc. There has to be unanimous consent. Everyone has to agree, or else the motion does not get passed. The fourth kind of investment that we may have is a simple trade investment. That will be held for some kind of wealth accretion or financial gain. Maybe the investor hopes to get some kind of income from that investment via dividends. Alternatively, maybe the investor is hoping for some kind of capital appreciation. In any case, it is classified as a simple trade investment, a financial asset, and the relevant standard here is IFRS 9. That's quite a significant chunky standard. There's so much to learn there that it's got its entire own chapter. In fact, it's got a couple of chapters. You're going to see that later on in the course. Now, I want to talk a little bit about this idea of control. So in FAR, we thought control was simply a shareholding of greater than 50%. But in reality, it is a little bit more complicated than that. In reality, an investor controls an investee if and only if the investor has power over the investee. Okay? It has power to direct the relevant activities. Okay? And indeed, that definition is given in the notes. Power is all about being able to direct the relevant activities of the investee company. Furthermore, the investor must have exposure or rights to variable returns of the investee entity. Okay? So in a good year, it gets to benefit from the high dividends. In a bad year, it has to take its share of the losses. And further, the investor has to have the ability to use its power over the investee to affect the amount of the investor's returns. So another way of saying it controls the economic decision. It can influence the results of an entity or performance of an entity in any given year. If control exists, then we must consolidate the results of the subsidiary and the parent as if they were a single entity. Now, in the exam, you need to be able to discuss whether control exists or not. It won't be so clear-cut. Okay, sometimes they'll give you some conflicting information and you need to make a judgment based on the weight of the facts whether the investor has control, ergo we consolidate, or the investor does not have control, in which case it's going to be an associate or some other kind of investment. Okay, so how do we assess whether an investor has control in the subsidiary or not? Well, we look at the shareholding. Okay, that's the starting point. Do they have greater than 50% of the votes or not? That's only a starting point, because after that, we need to consider whether the investors actually exercise the majority of their votes. Because I may have the right to vote, I may have the right to vote over a particular company, but I may not actually exercise that right to vote. So we have to look at what practically happens in reality, not just what the legal documents tell us. So it's one thing having the right to vote, but it's another actually exercising that right to vote. You need to consider whether there are any agreements with the other investors. Okay, do they have some kind of agreement where one investor doesn't, it remains silent, doesn't really have decisions over operating activities? We need to consider how dispersed the shareholdings are. Okay, are there a few investors with lots of votes, or are there many, many investors with a small number of votes? Okay, many, many investors with a small shareholding each. We also need to consider whether the investors hold any potential voting rights as a result of holding convertible debt or options. Okay, and this is an interesting one. So when we talk about potential voting rights, we're asking, does the investor have a call option over that company? And remember what call options are from back in your FM days. Okay, a call option, and in fact, let's just make a note here. Remember what that is. It is the right, but not the obligation, to buy shares at a fixed price, at a set price. Okay? Well, this will give rise to potential voting rights, won't it? Because I may be, in fact, let's look at the illustration, because this nicely sort of shows what I mean. Poppy holds 45% of the shares in Shiba. It also owns warrants on Shiba, which are currently exercisable and give Poppy an extra 10% of the voting shares. Now, warrants, you might not have seen that before, but they're similar to call options. Okay, it gives the warrant holder the right but not the obligation to buy more shares at a fixed price. So, in this situation, Poppy holds 45% of the shares, hence 45% of the votes. It doesn't seem like Poppy has control, but Poppy could exercise those warrants and achieve an extra 10% of the voting shares. Hence, Poppy's shareholding, or potential shareholding, would be 55%. Well, this would suggest Poppy has control. even though she hasn't exercised the warrants yet, the fact that she could means that she could exercise control. So we must consider any potential voting rights. We must consider any potential voting rights to determine whether control exists or not. Okay, and we consider that in conjunction with the other factors. One other thing I'm going to highlight from this illustration is that the voting rights must be currently exercisable. Okay, they must be currently exercisable. So just be careful for that, because there is a question in the question bank where there are some warrants, but they're not exercisable until the future. So I would say always check the date of when the warrants or options are exercisable. If it's in the future, then it doesn't count, and we do not include them as potential voting rights. Okay. Now I want us to talk through illustration 2. Okay, this is a nice kind of example of how control isn't always so clear-cut. So here we've got Cloud, a public limited company. Its sole operating activity is to invest in the other businesses for the purpose of capital appreciation. Okay, so Cloud invests in other companies. During the period, Slade purchased 47% of the equity shares in Cloud. The next biggest shareholder owns 6% of the equity shares. Cloud has no potential voting rights in issue, so we don't need to worry about that for the minute. Attendance at Cloud's annual general meeting over the past 5 years has averaged 77%. So we see in this situation that Slade, who owns 47% of the equity shares in Cloud, could potentially have the majority of the votes. Because if the attendance is only 77% and Slade can exercise 47% of the votes, well, that would suggest Slade is exercising the majority of the votes, thus has control. That's one thing to consider. Decisions around day-to-day management of investments, as well as decisions to buy or sell equity interests, are taken by Cloud's management and its board of directors and do not require approval at the annual general meeting. So it looks like the day-to-day decisions are made internally within Cloud. The investors don't really get to say. Slade does not really get to say in how Cloud is managed day to day. Slade has appointed one of the 5 members of Cloud's board of directors. Legal limitations in Cloud's jurisdiction prevent Slade from taking a majority position on the board. So the question is, does Slade have control over Cloud? Well, Slade has less than 50% of the ordinary shares, so does not have a majority holding of the voting rights. Having said that, because the other shareholdings are quite dispersed, it is unlikely that there are enough shareholders which would oppose Slade's position. So this paragraph suggests control, doesn't it? Even though Slade has less than 50% of the voting rights, because of how things work in practice, they are able to exert control via having the majority votes. Moreover, it is likely that attendance at the AGM is not high enough for Slade's position to be successfully opposed. So again, suggests control. However, even though Slade is likely to control the vote at the AGM, it does not exercise power over control. This is because key activities that affect the returns of buying and selling investments are made by the board of directors and not at the annual general meeting. Slade has one director on the board and is prohibited from controlling the board, so is not currently able to direct these key activities. So the final paragraph suggests that Slade does not control Cloud. On balance, in this illustration, we have made the decision that Slade does not control Cloud. In your real exam, you have to show an argument. You need to make a discussion, weigh up the facts, balance out, okay, does control exist or not, and then make a decision. Your decision matters because it will impact the subsequent financial reporting treatment and the financial accounting treatment, won't it? Because your decision will impact whether we treat the underlying entity as a subsidiary and therefore consolidate, or whether we treat the underlying investment as an associate, in which case we'd have to equity account for it. Okay. Great question, Silong. Do you get follow-through marks if the decision made was incorrect? So again, if the examiner has intentionally made the information a little bit ambiguous, then you will get follow-through marks, yes. Okay, so it'll depend on, you know, if it was very obviously a subsidiary and a candidate failed to identify that, okay, so there were loads of obvious reminders, obvious kind of hints, and the candidate failed to pick up on that, you won't get follow-through marks. But if the balance of facts is fairly in the middle, then as John says, okay, it would depend on your argument and the information you pick up relating to control. I think that's a good way to put it. If it's balanced, if it's fair, you will get some follow-through credit. Okay. There is a little bit left to cover on this section, so let's just get through it. When we talk about significant influence, the bright line criteria was to have a shareholding of between 20 to 50%, but as well as that, we need to consider other kind of indications. The existence of significant influence can be evidenced in other ways. So it can be through representation on the board of directors. That's not to say that the investor has the majority appointments on the board of directors, but maybe they are able to appoint 2 out of the 5-member board. It could be that the investor has participation in the policy-making decisions and policy-making process, including about how dividends are distributed. So indeed, if the investor gets to have a say on the level of dividends, that suggests significant influence. Are there any material transactions between the investor and its investee? Now, this was a past exam question. Okay, if you look in your question bank, question EC, that is exactly what happened. The investor was involved in some material transactions with its underlying entity. And so even though the shareholding was, can't remember, it was not between 20 to 50%. It was not very clear cut whether the investee company was an associate or not, but there were material transactions between the entity and the investee. So that suggested that significant influence did exist. Is there any interchange of management personnel? So are they swapping directors every so often? Is there the provision of any essential technical information? Now, I reckon, it's probably handy to have these pages tabbed up in your workbook, because where you've got a question with one entity having an investment in the other, they're going to give you a big paragraph full of facts, and you need to look at the information, look at the facts, and check it against this list of indicators as to whether significant influence exists or not. So this is one of those handy pages that you could just have tabbed up and refer to if you had a question on discussing whether control or significant influence exists. Joint control, just have a read through at home. Exemptions, again, just have a read through at home in your own time. Okay. Other matters. So other matters just talks about the accounting period. Okay, making sure that when we consolidate financial statements, we are consolidating like-for-like periods. Sometimes it is not always possible. So maybe you have the parent whose reporting period is from the 1st of January all the way to the 31st of December. And then maybe you've got the subsidiary that has a slightly different reporting period. Maybe the subs reporting period is from the 1st of February all the way to the 31st of Jan. Well, in that case, what the accounting standards allow is for you to still consolidate, even though they're not like for like, but you need to make adjustments for any material transactions that took place in the gap. Okay, so it says here in the notes, the subsidiaries accounts may still be used for consolidation, provided that the gap between reporting dates is 3 months or less, and that adjustments are made for the effects of significant transactions or other events that occur between that date and the parent's reporting date. So in this example I've done on the board, we have a 1 month gap. So the parent can still consolidate, but we need to adjust for any significant transactions between the 1st of Jan and the 31st of Jan. Okay. It goes without saying that uniform accounting policies need to be used by all entities in the group. So if one entity is applying IFRS, the other entity is applying UK GAAP, then we need to make consolidation adjustments to make sure that the same accounting standards are applied. Okay. That takes us through our starting point for Chapter 2. Let's take a break here. Take quite a lot to take in our first session. Let's come back at 11:20, okay, and then we can make a start on the nitty-gritty to do with the actual production of consolidated financial statements. Can you still hear me? Can you hear me? Oh, okay. Thank you. Yes, that was without the headset. Do you know how I change it by any chance? Okay, how about now? And can you hear me type? Oh, okay. Yep. How does that sound?
Okie doke. It is 11:20, so come back everybody. I didn't realize, but I was having a few sound issues earlier on, so I've adjusted my settings. Hopefully the sound is a lot clearer and nicer for you now. You don't have the sound of me typing away furiously on my laptop. So welcome to session 2. Okay, this session should be about an hour, possibly a little bit longer. We're going to remind ourselves of our consolidated SFP standard workings. So a lot of this will be a recap from back in your FAR days. We're going to remind ourselves about the various different methods. Oops, sorry, I meant to write fair value versus proportionate method. Okay, so remember that back in FAR, when we calculated the value of our non-controlling interest, which of course impacted our goodwill calculation, we had two options available. The non-controlling interest could be measured under the fair value method or the proportionate method, sometimes called the share of net assets method. So that's significant because it impacts the value we calculate for our non-controlling interest to be reflected in equity. It reflects the value we calculate for our goodwill. So we're going to remind ourselves of the difference between these two methods, and we are going to get impairments of goodwill out of the way as well. So quite a lot to get through in this session. Let's go back then into chapter 2. As I said, we're starting off with reminding ourselves of the consolidated SFP. So here we have in your workbook the standard pro forma for the consolidated SFP. Now, in a very basic sense, when we talk about consolidating a subsidiary, we're talking about adding up all of the assets, all of the liabilities, all of the income and the expenditure. So in the SFP, some of the easiest marks you ever get will be to add up all the assets and liabilities of the parent and the subsidiary, and we reflect that within the brackets. Okay? So those are your net assets. We consolidate 100% of the net assets because remember that the parent controls the net assets of the sub. So I'm just going to add a few extra notes here. Parent consolidates 100% net assets of the sub because it controls the net assets sub. Okay? And that is reflected within the assets and liabilities section. We're showing consolidated figures. However, remember that when we look at the equity section, with share capital, we reflect the parent's share capital only. Okay, we don't reflect any of the subsidiary share capital balances. It is the parent only. And then we calculate a value for group retained earnings, the standard reference to working 5, and that shows the proportion of the reserves that belong to the parent. Okay, that belong to the owners of the parent. We have this extra line we need to include, and that is your balance for the non-controlling interest. What that balance represents is the proportion of the subsidiary's net assets that belong to the other guy, okay, to that other investor, that minority interest, that non-controlling interest, as we call it under IFRS. So P consolidates 100% net assets of the sub because it controls the net assets of the sub. However, it does not own 100% of the sub. Thus, we show the NCI balance within equity. Okay? The net assets denote control. The equity section is where we understand the ownership of the group. Okay, is where we understand the ownership of that subsidiary. So We've got our standard balances, group retained earnings, the non-controlling interest, standard workings 5 and 4. If you don't remember them, don't worry, we will go back to it in a minute. Other consolidation-specific lines we tend to see within the SFP are, of course, goodwill, your standard working 3, and the investment in the associate or joint venture, for which we usually have to do an extra working. Let's just call it standard working 7. Okay. So on the next few pages, we have our standard workings for the consolidated SFP. I'm going to mix up the order a little bit. We will go through the other workings, but for the minute, the first working I want to go through in a bit of meaningful detail is the goodwill working. That's your standard working 3. So I'm going to ask you if you could please get out a clean sheet of paper, because you won't be able to squeeze it into your notes. Let's remind ourselves of all of the elements of goodwill, of the goodwill working. Okay, so I'm going to turn off my screen so I can write on my laptop. I've just had a message to go back to my notes, so I'm just going to leave it there so everyone has enough time to copy out the information. Please, could you get out a clean sheet of paper whilst we wait? Okie doke. So let's talk about the goodwill working. The starting point for goodwill is the fair value of consideration transferred. Okay, so when we look at the consideration to acquire a subsidiary, we note that it could be in the form of cash consideration, it could be in the form of other types of consideration. So we need to go through all the different types of ways in which a parent can acquire a subsidiary. One of them is through paying cash today. Okay, so that's one way of acquiring a sub. Pay some cash today. The double entry is going to be to debit your investment Okay, and this will eventually end up increasing the goodwill figure that you calculate in the consolidated SFP and crediting cash. So debit the investment, credit cash. We could also have deferred cash. Okay, so I want you to leave loads of space. We want loads of lines, loads of nice clear workings. So the other kind of consideration is deferred cash. Can you remind me, at what value do we recognize deferred cash in the goodwill calc? At what value do we recognize deferred cash in the goodwill calc? Thank you, Sabine. You are right off the mark. You said present value, and you would indeed be correct. Because of the time value of money, the amount we include in the goodwill calc is not the amount payable, but the present value of the amount payable. Your double entry is to debit the investment and credit some kind of liability representing how much you will pay in the future. Now, what do we do subsequently to that liability? Unwind the discount. Thank you, Sabine. Thank you, Mark. So subsequently, don't forget to unwind the discount. What does that mean? Well, we multiply the liability by the relevant discount rate, and that amount is going to be a debit to your finance costs It's a charge through the P&L reflecting the cost, the time value of money, and with a corresponding increase to the liability because we're 1 year closer to making out that payout. So we could have cash now, we could have deferred cash, we could have shares issued now, we could have shares issued in the future. At what value do I recognize the shares? At what value do I recognize the share consideration? Market value, absolutely. Thank you, Sabine. Someone's done their pre-coursework. So it is at the market value of the shares at the acquisition date. Now, the examiner will be kind. He or she will give you that number in the exam. But remember, we always take the market value at the acquisition date. Okay, don't be fooled if they give you any red herrings and tell you the share price at a future date. No, no, no. It is always at the acquisition date. In terms of the double entries, well, with shares issued now, we can debit the investment and credit your share capital and your share premium accordingly. Where we've got deferred shares, oh, I forgot to put an S there. Where we've got deferred shares, we'll have to debit the investment and we credit equity. Okay, so we'll have to credit an account called shares to be issued, and it does exactly what it says on the tin. Hey, it reflects the shares that are to be issued in the future. The last kind of consideration we have is, of course, your contingent consideration. Okay, so this is an amount that may be payable in the future, but it is contingent upon the outcome of a future event. Okay, maybe the subsidiary needs to achieve a certain profit figure for the year. Maybe it needs to achieve a certain amount of sales before the extra amount is payable. So where we've got contingent consideration, it could be in the form of cash, or it could be in the form of shares. Okay? In either case, we need to recognize the amount of contingent consideration at fair value, okay? And again, that will be given to you in the question. The double entry is to debit the investment and to credit a provision if the amount payable is in cash, or to credit shares to be issued. If the contingent consideration is in the form of shares. So you add up all of these different figures, and that is going to get you the fair value of your goodwill consideration. Okay, all that to pretty much get you to the top line of your goodwill calc. So in the corporate reporting exam, it's not enough just to know the working. You have to really get what's going on. You have to really understand the impact of these different forms of consideration on the accounts, and that's why I've provided you with the double entries. Quite often, maybe in the exam, there's a mistake, okay? They forgot to include a certain type of goodwill consideration. Maybe they ignored any deferred cash. So you need to understand what is the impact to the financial statements of adjusting for this. Well, we'd have to recognize a liability, wouldn't we, on the SFP? We'd have to then subsequently unwind the discount on the liability, which will include or result in a finance cost in the P&L and an increase in the value of that liability. So you have to really get it. You have to really get what's going on beyond learning just a few standard workings. So we've got the fair value of consideration. To that, we then add on the value of the non-controlling interest at the acquisition date. Now, this number could be under the proportionate method or the fair value method. So this initial number could be the NCI percentage multiplied by the net assets of the subsidiary at the acquisition date. That would be the proportionate method of calculating the non-controlling interest, or this value could be measured at fair value. So it's one or the other. The exam question will tell you which method to apply. We then deduct 100% of the net assets of the subsidiary at the acquisition date. This figure we usually calculate when we do our standard working too, which I will remind you of shortly. Take one figure away from the other, we end up with goodwill as at the acquisition date. Can anyone remind me? If this value is negative, what do we do with it? What do we call it? We credit the P&L. Thank you, Sabine. That is what we do with it. So if this value is negative, then we take that as an immediate credit to the P&L. Okay, so that's going to be a gain for the acquirer. And we call this a gain on bargain purchase. What has happened is you've basically paid less than what the subsidiary is worth. Great. Got yourself a bargain. Credit the P&L. It's going to be some kind of other income. Now, goodwill is an intangible asset. Under IFRS, it has presumably an indefinite useful life. What must we do to all intangible assets with an indefinite useful life? What must we do to all intangible assets with an indefinitely useful life? Brilliant. Okay, wonderful. I love that answer. We test for impairment, Sabine. Thank you very much. And we do it every year. So we say that we review annually for impairments. And in the goodwill calc, we deduct all impairments to date. And that will give you your goodwill figure as at the balance sheet date. Or, because we're doing IFRS, statement of financial position date. Okay. Beautiful. So I'll just leave that on the screen for a little while longer so you can copy out the notes. And then we're going to jump back to our standard workings. Okay. So, standard workings then. Standard working 1 is your group structure, no different to what you have seen in the past. Standard working 2 is your net assets of the subsidiary, and this is quite a significant working because, of course, your results from this working feed into your subsequent workings. So going through, we need to work out the net assets of the subsidiary at the acquisition date and at the period end date, or at the SFP date. Now, when we talk about the net assets of your subsidiary, Remember that your net assets are represented by the equity section of the SFP. And that's all because of our accounting equation. Assets equal equity plus liabilities. Your assets minus your liabilities equal your net assets, which also happen to equal your equity. As such, we can say that your net assets is represented by your equity balances, being your share capital, share premium, your retained earnings, and other reserves. So we need to work out the net assets at acquisition and the period end. We also need to work out the movements in these balances since acquisition. Now, for share capital and share premium, the movement will always be zero because the subsidiary will never have issued shares in the interim. For your revaluation reserve and your retained earnings, there will be a movement, and we take these movements to our working 5 for group retained earnings and our working 6 for our group revaluation reserve. We also need to work out the net assets at acquisition, which feeds into working 3, and net assets at period end, which feed into working 4. Now, bear in mind, we frequently have to adjust this working. Okay, remember, what kind of adjustments did we see feature in working 2? Thank you for Sabine. You are absolutely right. We had fair value uplifts, and thank you, Rebecca, we did indeed have perps. So be prepared to make adjustments. Okay, we're going to have fair value uplifts on property, plant, and equipment. If we have an uplift on PPE, then we must do to that uplift what we do to all PPE, depreciate it. So we've got the uplift, we've got the depreciation, we've got perps, where of course the subsidiary is the seller. We've got other kind of fair value adjustments, which we will remind ourselves of in a moment. But just so you're aware, when we do this question, it's quite likely we have to leave some space for our adjustments. Goodwill we've already done. Okay, which is great news. So we can just skip this and go straight to our working 4. Working 4 is the non-controlling interest. Sorry, I'll just go back to this page so everyone can jot down the notes. Do stop me, anybody, if I am going too fast. Beautiful. So working 4 is the non-controlling interest. Remember what this balance represents. It's the proportion of the subsidiary that belongs to the other guy, okay, to that minority interest figure, the one who, has just a few of the shares. So we've got 2 methods for calculating the NCI. We've got the fair value approach and the share of net assets or proportionate method approach. Now, the proportionate method is a lot easier. Okay, that's the one you perhaps remember from back in FAR. We take the NCI share of the subsidiary's net assets at the year-end date, which you would have calculated from working 2. So that's the more straightforward method. But the alternative method is, of course, the fair value approach. Sometimes this is called the full goodwill method. And it is calculated by taking the fair value of the non-controlling interest at the acquisition date, which will always be given to you in the exam question. We add the NCI share of any post-acquisition movement in retained earnings and any other reserves from working 2, and then knock off the NCI share of the goodwill impairment, which you would have calculated from working 3. Now, I'm going to elaborate on the difference in these two methods shortly. Okay, so hold your horses there. We will come back to this. Group retained earnings involves taking 100% of the parent's retained earnings, the parent's share of any change in the subsidiary's retained earnings since acquisition, knocking off any in goodwill impairments from working 3, adding on any gain on bargain purchases from working 3 to get your closing figure. Bear in mind, we do often see adjustments to group retained earnings. We may see adjustments for perps, where the parent is the seller. Okay, we may see adjustments for other kinds of things. We may see adjustments for pretty much anything that impacts group retained earnings, that impacts the group profit and loss, and therefore subsequently impacts retained earnings. One example may be unwinding the discount on deferred cash consideration. Your group reserves is a very similar kind of working. We take 100% of the parent's reserves and then the parent's share of any changes in reserves since acquisition. Other things to consider when it comes to groups, pretty much any part of accounting really, is on mid-year acquisitions. It says you may not be given the subsidiary's reserves at the acquisition date, in which case you will need to prorate the subsidiary's profit for the year and add it to opening reserves or subtract it from year-end reserves. So my favorite game. Okay, we'll just have a go at this quickly so we're all on the same page. Let's say that I am tracking the balance of my retained earnings. So on the 1st of January, I had retained earnings of 840. I made profit for the year of 125. Maybe on the 31st of July, a dividend was paid of 50. My question to you is, what was my retained earnings on the 31st of December? This is easy. I expect everyone to get this. Jack says 915. Any other takers? Nope, we'll just go with Jack then. And indeed, you are correct. What were my retained earnings at the year end? Well, I started off with 840. The company earned profits for the whole 12 months of 125. They paid a £50 dividend, so my retained earnings at the year end is £915. Okay. What were my retained earnings on the 30th of September? We assume profits accrue evenly. Yes, good point, Sabine. $884 says Rachel, you would be absolutely right. For the 30th September balance, we take 840. We prorate the profits for 9 months out of 12. Okay, because we only won the profits up to September. We knock off the dividends, so we get 884. One more, and then I promise we'll move on. What were my retained earnings on the 28th of February? What were my retained earnings on the 28th of February? Okay, what do we have on the chat panel? 860, 860, 861. Okay, let's take a look. So 2 out of 12 times 125 equals 20 plus 840 gives me 860. Absolutely. So hopefully you all took 2 months out of 12 times the profit. So I get 861. Yep, 861 with a little bit of rounding. Okay, you are all on the ball. We ignored the dividends because, of course, dividends are accounted for on a cash basis. So if I won the retained earnings before the dividend period, before the date the dividend was paid, then I exclude the impact of the dividend. Lovely. So we're all on the same page. We know how to deal with mid-year acquisitions. We know how to calculate retained earnings at a particular point in time. Let's think about the other kind of common consolidation adjustments we tend to see with accounting. So at the year end, current accounts may not agree owing to the existence of items in transit, such as cash or goods. Okay? When we talk about current accounts, we're just talking about the intercompany balances. So one company has a payable, the other company has a receivable. Well, in that instance, where the balances don't agree because we either have cash or we have goods in transit, what we must do is, simple rule, we have to pretend the cash or the goods have been received. And what that means is, with regards to cash in transit, we debit cash and credit the receivables current account. So we pretend that the company who had paid the cash just before the year end had actually made the payment, and we pretend like the receiving company received the cash before the year end, even if that didn't actually take place. So you're going to pretend the cash has been received, debit cash, credit receivables current account. If goods were stuck in transit, you're going to pretend like the goods have actually been delivered. You're going to pretend like the receiving company has actually got the goods. So you're going to debit inventory and credit the payables accounts. Once this is done, then your receivables and your payables should agree. Okay? There are going to be no amounts in transit, and therefore the receivable in one company should agree to the payable in the other, and we can then cancel out the receivable in one company with the payable in the other. So what does that mean? Well, in double entry speak, debit your payable, credit the receivable. Now, how does this impact your workings? Well, you need to show this in the brackets. Okay. So quite often, when you do these adjustments, it's because the examiner wants you to redraft a set of financial statements. So you're going to have your draft column with the numbers from the question. Every time you make an adjustment like this, you just increase or decrease a number within the brackets. And actually, we're going to see that in a question coming up soon. Okay. Moving along, let's think about PERPs. Okay, so PERPs, of course, stand for your provision for unrealized profits. Okay, and this arises when one company trades with another group company. So the parent has made a sale of goods to the subsidiary. Well, in the individual financial statements, they're valid sales, they're valid purchases. But when we're treating the parent and the subsidiary as if they're one single economic unit, then it's like me selling something to myself. Okay, I haven't really sold it. It's not realized. The sale is only realized when the sale's been made outside of the group to a third party. Now, perps are broken down into inventory perps and PPE perps. With inventory perps, we want to find out any profit made on intercompany sales that relate to goods still held at the year end. Because if the parent has sold goods to the subsidiary and those goods remain in inventory within the group at year end, then any profit made on those sales is unrealized. Okay, it's like me selling something to myself. Okay, it's not a real sale. It's not a real profit made on sale. So what we need to do is calculate a perp, and then we post our double entries. We make an adjustment for the perp. So this will require you to remember a little bit around your cost structures. So I'll give you a little bit of an example in the notes here. Can I squeeze it here? Ooh, I think I can probably squeeze it here. Okay, so let's say that I sell goods for £625. I'm making up some numbers at a 30% markup. Well, when we're talking about markups, we're talking about markups on cost, okay? So what that means, if we expressed the sales figure and the cost figure in percentage terms, is that the cost number represents 100% and the sales figure represents a markup on that cost figure. So a markup on cost of 30% means I sold something for 130, it cost me 100, my profit is therefore 30. Now this is that's expressed as percentages. We can do a little bit of cross multiplication and division to work out what the profit was in absolute figures. So if the goods were sold for 625, a little bit of cross multiplication and division will tell me 625 times 100 divided by 130 gives me 481, and a profit element of, what am I doing, of 144. So this is the profit made on the sale. You multiply by the percentage of the goods still held in inventory. And that will be the number we adjust for our perp. In terms of the double entries for the perp, well, the double entries, the accounting adjustment depends on who is selling to whom. So if the parent is selling to the subsidiary, then we debit group retained earnings, that's standard working 5, and we reduce inventory on the face of the SFP. But if the subsidiary is selling to the parent, then we'll have to debit the subsidiary's retained earnings, which is in working 2, and reduce group inventory on the face of the SFP. Okay? So those are the double entries for a perp. We may very well need to calculate the perp, and that will involve your knowledge of cost structures, as I said. So we could have goods sold at a markup, or we could have goods sold at a profit margin. So I'll give you another example here. Let's say that I sell goods for £800 at a 15% gross profit margin. Well, when we talk about gross profit margins, then in percentage terms, we're saying the sales value represents 100% and the gross profit is that margin of 15. So if we know the cost structure, with a bit of cross multiplication and division yet again, we should be able to work out the profit made on the sale. So I sold the goods for 800. 800 times 85 divided by 100 is going to give me 680. So that must have been the cost of the goods, making me a profit of 120 on the sale. And we then multiply by the percentage still held in inventory. Okay? So that's just a brief reminder on your markups and your gross profit margins. Now, that was dealing with inventory perps. Remember that it is also possible for us to have a PPE perp. Okay, so that is where PPE is sold between group members. Okay? Now, if one entity sold an item of PPE to another entity, then it's quite likely that on the transfer of that asset, the seller would have made a profit on the sale, number one. And secondly, the buyer would have been charging a higher amount of depreciation because it would have been based on the higher transfer value. Okay? Now, for the PPE perp, we want to make an adjustment so we arrive a situation, or so we reflect the situation as if the transfer had never taken place. We want to make an adjustment so it's as if there was no profit on sale and depreciation is based on the original cost of the asset to the group. How do we calculate the PPE perp? Well, we compare the carrying amount of the asset at the year end following the transfer. And we compare that to what the carrying amount of the asset would have been at the year end if the transfer had not taken place. So we take one number away from the other. That difference is the non-current asset perp. And your adjustment is to debit retained earnings of the seller. Could be working 5, it could be working 2. And we reduce the value of the asset on the SFP. Okay. Okay. Moving along, let's look at the fair value of net assets. Okay. So this is all really in relation to working 2. Going to turn off my screen, so we can see. Now, this is all because at the date of acquisition, the parent entity must consolidate all assets and liabilities at fair value. The problem is that in the subsidiaries books, the carrying amount of the assets and liabilities do not necessarily equal the fair value of the assets and liabilities. And for that reason, we have to make a series of fair value adjustments which impact our working 2. Okay? So let's see if I can squeeze it to the side. Yep, I'll squeeze it over here. Remember that when we do working 2, we need to show the net assets of the subsidiary at the reporting date, at the acquisition date, and then we work out the post-acquisition movement. Your net assets will consist of share capital, the reval surplus, and retained earnings. Okay? So that was the starting point. That was the pro forma we saw a few pages ago. But we know that we need to make a series of fair value adjustments. One of them could be for a fair value uplift. So this is where we may see that the carrying amount of property, plant, and equipment is not the same as the fair value of the property, plant, and equipment. So we need to make an adjustment between for the difference between the carrying amount and the fair value of those assets. We reflect that adjustment both at the acquisition date and at the SFP date. Okay, at the acquisition date and at the SFP date. Subsequently, we'll have to reflect any depreciation of that uplift. Remember, that is reflected only in the SFP column because it reflects all accumulated depreciation since acquisition. What other kind of adjustments have we seen here? What other kind of adjustments have we seen here, guys? What do you remember? Yep, perps we saw. What other kind of fair value adjustments? Perp is a valid adjustment, but I'm looking for the ones that relate to fair value. Intangibles, beautiful. So we may have a fair value uplift on PPE. We'll put uplift on intangibles. Okay, and then we'll have to have the subsequent amortization of those intangibles. What else have we seen? What else do you remember? Anything? It's kind of given in the question, in the notes. Yep, internally generated stuff. I love it. Okay, internally generated stuff. We'll keep that as part of the intangibles. But I have some good recommendations here. We've got goodwill. G, please present to all participants so everyone else can see your contribution. You're absolutely right. We've got goodwill in the subsidiaries books. Okay, and that would be a reduction. So let's say that the parent has gone along and acquired a subsidiary, which in turn had acquired the trade net assets of a sole trader's business some years ago. The subsidiary may be recognizing goodwill in its own financial statements. Well, that may be fine in its own financial statements, but on consolidation, we need to remove that goodwill. The reason is because it is not identifiable. And whilst we're on it, let's just define what we mean by identifiable. Well, that is something which is capable of separate disposal. And or arises from some kind of contractual right. Well, goodwill in the subsidiaries books is not identifiable. Okay, it's not identifiable because we can't package it up. We can't separate it from the subsidiary and sell it on to anyone else. It's not identifiable, so we have to remove it on consolidation. There's one other adjustment I'm thinking of, and that is contingent liabilities. It is mentioned in the notes. In the subsidiaries books, the subsidiary, if it had any contingent liabilities, would have disclosed it in its financial statements. However, it wouldn't have recognized the contingent liability in the financial statements. Well, on consolidation, we do recognize it, and we add and we recognize it at its fair value. So you've got all the adjustments here to your standard working to. Always a good idea to leave loads of space, therefore, to reflect those adjustments. Other types of adjustments we may see. Well, one more thing we need to think about is that when a parent acquires a subsidiary, these fair values are all estimates. Okay? So usually what will happen, there'll be a big deal team, there'll be loads going on behind the scenes, there'll be loads of deal people working on the right share price, valuing all the assets, valuing all the liabilities, and it may be that as at the acquisition date, the fair values are provisional, okay? They are estimates. Because it's not that easy always to determine the fair value of things, the fair value of items. Now, ideally, the fair value should be ascertained before the year end of the accounting period under audit. But of course, this may not be possible. For example, if the acquisition was made on the last date of the year. So standard allows the use, okay, so it allows the use of provisional fair values, which is to say an estimate of fair values, and subsequently, if there are any adjustments to those provisional fair values, those adjustments will be dealt with differently depending on whether they are made in the measurement period or not. When we talk about the measurement period, we're talking about 12 months from the acquisition date. So if those provisional fair values were adjusted for within 12 months of acquisition, then an adjustment is made retrospectively. What that means is we go back to the previous, we go back and we recalculate goodwill. Okay, we recalculate goodwill. Why on earth is goodwill impacted? Well, if we've had to make a retrospective adjustment to our fair values, that is going to impact my net assets of the subsidiary as at the acquisition date. And remember, this number here feeds into working 3 my goodwill calculation. So if we have an adjustment to any of these fair value figures, well, that is going to impact your net assets at acquisition, hence impact your goodwill figure. If the adjustments are made within the measurement period, so within 12 months from acquisition, we go back and recalculate goodwill. If the provisional fair values are adjusted for outside of the measurement period, then they are treated as a change in accounting estimate and adjusted for prospectively. What that means is, well, we just remeasure the assets, remeasure the liabilities with any movement going to the P&L. They changes really. Any changes in fair value record in the statement of profit or loss. Okay. Okie doke. Moving along, I did say we would come back to this. Okay, we've got the different methods of measuring the non-controlling interest and hence also in measuring goodwill. So let me illustrate this pictorially. Okay. So let's say on this axis we have the percentage ownership of a subsidiary. And on the other axis, we've got two things. Okay, so at this stage here, what we have is the value of the net assets of the subsidiary. And here we've got the net assets plus the goodwill. Okay. Now let's say that 80% of the sub is owned by the parent, and then you've got the remaining 20% of the subsidiary that is owned by the non-controlling interest. Okay, so everything within this box reflects 100% the net assets of the subsidiary. Everything within the other box represents 100% of the net assets of the subsidiary plus goodwill. Okay. So we can also say then that this bottom lower left quadrant represents the parent share of the net assets of the sub. We can say the upper left quadrant represents the parent share of goodwill. And then in the right-hand side quadrants, we've got the NCI share. So under the proportionate method, okay, which is this one here, under the proportionate method of measuring the non-controlling interest in goodwill, what we're doing is including 100% the net assets of the subsidiary, but only the parent share of goodwill. Okay? That's the proportionate method. The proportionate or share of net assets method. The reason we call it that is because when it comes to measuring the non-controlling interest, we are only including the NCI share of net assets of the sub. Okay, we are only including this bottom right-hand quadrant. Under the fair value method, or the full goodwill method, we include the NCI share of goodwill in the consolidated accounts. Okay? So under the share of net assets method, we're only including this quadrant. Under the full goodwill or the fair value method, we are including this whole quadrant. Okay? That's essentially the difference between these two valuation methods. The reason it matters is because it is going to impact your working three and your working four, which method you have chosen. The choice is made on an acquisition by acquisition basis, and you do not need to be consistent. So some subsidiaries could have their NCI and goodwill measured under the fair value method. Some may have their NCI and goodwill measured under the proportionate method. You need to be comfortable with both. Okay. Now, following on from that, oh, just got a question there. Is the quadrants included the ones you have lined over in green? So color-coded. So for the proportionate method, it's everything highlighted in red. And under the fair value method, it is including the upper right-hand quadrant. Okay, so what we're saying is that under the fair value method, your value for the non-controlling interest is going to be bigger because we're including not just the NCI share of net assets, but also the NCI share of goodwill. Now, this does impact any subsequent adjustments we have on our goodwill figure. Okay, so let's think about, I'm just going to give you an example here. Let's say under the proportionate method, you have a goodwill impairment. Well, under the proportionate method, we haven't included the NCI share of goodwill, okay? It's not reflected anywhere in our financial statements. It's not consolidated. It is not included in the goodwill figure. And as such, when we impair the goodwill, all of that impairment must be allocated to the owners of the parent, okay, to the group retained earnings, working 5. So we debit retained earnings, we credit goodwill, the full amount of the impairment. However, just got a question on the notes. What does the red line represent? Sorry, the red line is so this red box over here represents the non-controlling interest under the proportionate method. Okay. Maybe I just clear that off to make it a little bit neater. Now, goodwill impairments under the proportionate method would be allocated entirely to the owners of the parent, okay, because we are only reflecting goodwill of the parent on the consolidated SFP. Under the fair value method, we are reflecting not just the parent's goodwill, but also the NCI share of that goodwill figure. So when goodwill has been impaired, I'll just clarify, sorry, fair value method, impairment of goodwill. So under the fair value method, when we impair that goodwill, that is going to be allocated a proportion to the parent and a proportion to the non-controlling interest. The idea is that if the goodwill we are reflecting in the statement of financial position belongs partly to the parent and partly to the non-controlling interest, then any impairment of that goodwill must be allocated pro rata those percentage ownerships to the group retained earnings working and to the NCI working. Okay. Sabine asks, is one method preferable over another in practice? No, it's on a choice-by-choice basis, so companies have the option. Any can be used. I think in reality it'll also depend on what information is available. Sometimes it may be quite difficult to apply the fair value method if you don't have enough information available. If you've bought a if you've bought a private company with not any comparable data, but it is on a choice-by-choice basis. Okay, I'm going to pause here for a break because it is 12:24. There is a lovely, beautiful test your understanding I want us to have a go at, but I think we deserve just a quick breather. Let's come back at 12:30, so it's literally just a comfort break. Have a stretch, get a drink of water, and then we are going to try test your understanding 1. We're going to get that done before lunch. Okay, so let's come back at 12:30, please. Okay, 12:30, so welcome back, everybody. First question on the chat panel, am I going to do SBM? No, nope, that won't be me. I don't teach SBM, so check with your instructions from the PwC team who your tutor will be. Oh, you're too kind, Sabine. Okay. Okie doke. I'm sure you'll be in very good hands with whomever you are with on Wednesday. So let's pick up where we left off. Just before the break, we had a look through all of our standard workings for the consolidated SFP. We looked at the typical kinds of adjustments you may see. We talked about the differences between the fair value and proportionate method for measuring the non-controlling interest and goodwill. So now we're going to put it into practice. Here we have a consolidated SFP question. Draft statements of financial position for plant and shrub on the 31st of March as follows. Okay, so we've been given the SFPs for both entities, a few additional notes, and we are asked to prepare the consolidated SFP as at the 31st of March under both the fair value method and the proportionate method. Ooh, okay. So they want two SFPs from us. And indeed, that's what we're going to do, but we'll work together as a class. Okay, I want us to all be on the same page, and whether you like it or not, we are going to be practicing on the CBE software. Way. I can actually hear the shouts of enjoyment from across in the virtual room. So let's look at what information we have. You've been given the SFPs for both entities. As a starting point, you know that we must consolidate all assets and liabilities of the parent and the sub. That's all assets and liabilities except for this investment at cost. Okay, so this number here, this 180, well, we don't consolidate that figure, but where does that number go? That 180, where does it go? Goodwill, thank you, Sabine. Indeed, that goes into your standard working 3 to calculate the goodwill figure. Everything else we add up 100%. Within the equity and liabilities section, we've got balances for ordinary share, capital, share premium, and retained earnings we need to consolidate. I always do find it interesting that the parent has 0 share premium and share and retained earnings. That does look a little odd, but there's nothing else in it, okay? I just look at it and scratch my head a little, but there's nothing else weird going on with that. We're not meant to do anything about that. Let's look at the additional notes. So Plant bought 80,000 shares in Shrub on the 31st of March when Shrub's reserves included share premium of 30,000 and retained earnings of 5,000. They've given you the retained earnings figure as at acquisition. Okay, always look out for that because you will always need it to complete your consolidation adjustments. Plant's accounts show £6,000 owing to Shrub. Shrub's accounts show 8,000 owed by Plant. This is because of cash in transit. Okay, so we already saw what to do with cash in transit, didn't we? Where we've got cash in transit, first thing we do is pretend like the cash has been received. So in this case, Plant has clearly paid £2,000 to Shrub, but Shrub hasn't received the cash until after the year end. Doesn't matter, we're going to pretend like the cash has been received. So on the face of my SFP, I'm going to debit cash by the amount in transit, and I'm going to credit receivables. Then because I've reduced receivables down to 2,000, in theory, it should agree with the amount of payables. Now the receivable should be 6,000, hence we can then cancel out the intercompany balances. So that will be a debit to my payables, £6,000, and a credit to the receivables, £6,000. Beautiful. Number 3, year-end inventory in plant SFP included £20,000 of goods purchased from Shrub. So here we've got the subsidiary selling to the parent. Shrub sold these goods at a 10% profit margin. Okay, brilliant. So we've got 20,000 goods, £20,000 worth of goods that have been sold. The profit made on these goods sold was 10%. So that means my PERP is going to be £2,000. Okay, we assume all of this, in fact, we're told all of this is remaining in inventory at the year end. So this whole £2,000 profit is unrealized. We have to make a provision for it. So we debit retained earnings of the seller. Okay, in this case, the seller is Shrub. So we're going to debit retained earnings in our standard working 2. That's the retained earnings of the seller. And we credit inventory on the face of the SFP. Okay. Just give you a moment to finish copying that down, and then we'll go over to the next page. Number 4, the fair value of net assets of Shrub at acquisition were the same as the carrying value, with the exception of a major piece of equipment which had a fair value of £30,000 above the carrying value and a 10-year remaining useful life. Well, that sounds awfully like a fair value uplift to me. Where we've got fair value uplifts, we need to recognize the uplift as an increase in the net assets of the subsidiary and an increase in PPE. So what we're going to do, well, we're going to have to debit PPE on the face of the SFP. We're going to have to credit net assets of the sub. Well, that is going to be reflected as an adjustment underneath retained earnings in my standard working 2. That's the uplift. I then have to subsequently depreciate the uplift. So we need to be comfortable with the dates. We're trying to prepare the statement at the 31st of March 2007. Going back to the previous page, we see that Shrub was acquired on the 31st of March 2005. So we have 2 years' worth of fair value depreciation to calculate. The double entry for that will be a debit to the net assets of the sub. The amount of the depreciation is going to be the 30,000 divided by 10 years times 2, because 2 years have elapsed since the acquisition date. So that should give me, how much should that give me? 6,000. Debit net assets of the sub 6,000, which will be a reduction in my working 2, and credit PPE on the face of the SFP. The fair value of NCI at acquisition was 35,000. Great. Goodwill has been impaired by 5,000. Great. Okay, we just need to use that information to have a go at the question. So everyone, please could you get your CBE software out? Or if you happen to be on a laptop that doesn't have the CBE software downloaded, no worries. Just use an Excel sheet. Okay, that should do the job. Once everyone has the software open in front of them and it is running, can you just let me know on the chat panel, maybe click OK. Yes, it's working, or that you're ready, so I know we're ready to start. Thank you, C. Thank you, Binky. Thank you, Edward. Thank you, Sophie. Thank you, Thurston. Okay, thank you, Nicholas. Thank you, Nazik. Thank you, Jian. Beautiful. Okay, so I've got a few yeses there. Just give you a little bit longer. So we're going to have a go at this on the CBE software because I know we all love it. I know we all love getting some practice on it. Let me zoom in a little bit so you can see a little more. Once you've done your workings, remember you can download what you've typed so far by pressing the download button. Okay, that black arrow pointing downwards. It'll open up a new tab. Right-click print, save as PDF what you have done. When I finish my workings, I will also right-click print, save as PDF, and I will upload it onto my Kaplan so you can take a look. So first things first, let's draw up our statement. Okay, so remember that your examiner will only be able to see what is visible on the screen. So make sure you expand the columns, expand the rows if they are not visible to you. In the exam, there is still that one presentation mark going for full headings, proper set out, proper subtotals, but are you going to go for it? I mean, it's a personal decision. I personally think you have better fish to fry. So I'm going to abbreviate a little bit in my workings. I'm not going to go for the presentation mark here. Okay, so first things first, wherever we've got a consolidation question, always good to start off by drawing up your pro forma. We've got non-current assets for plant and shrub. We're going to have a line for our goodwill. Leave a reference to your to standard working 3. PPE, then your current assets. Okay, so once you've drawn up your full pro forma, I've included references for goodwill, retained earnings, and non-controlling interest. This is exactly the same approach you should take in the real exam. So draw up your pro forma. If you're sacking off the presentation mark, then that's fine, okay? The time-pressured paper, you've got bigger things to fry. So we're sacking that off. Just draw out your pro forma, get the bare bones. What we're going to do is leave a column for the proportionate method and for the fair value method because the requirement asks us to calculate the SFP under both methods. Okay. Then we go about copying our easy numbers. All right, so we can all do this. Just going to the question, copy across 100% assets and liabilities of plant and shrub. So for the minute, it's just lifting the numbers from the question into my answer sheet. Okay, so just give you a moment to finish jotting that down. Make sure you're comfortable with where all the numbers have come from. All I have done is take all the assets and liabilities from the parent to the sub. What have I written, Sam? Have I made a typo? Is it not 100 plus 140? Yes, you're right. Thank you for auditing my work. You must clearly be an auditor. Thank you for that. Okay, wonderful. So when we have got our, oh, I got it wrong, you're in tax. Oh, you should be in audit. I think you have a good career ahead of you there. Okie doke, so once we have our SFP set up, next thing, let us draw up our standard workings. So in this case, we have standard working 1, the group structure. Don't worry so much about, drawing circles or any faff like that. All we want to know is that plant is the parent and shrub is the sub. We need to work out the percentage ownership. So they haven't actually given you that in the question, but we could work it out. We have enough information because we know from note 1 that plant has acquired 80,000 of the shares issued by Shrub. And from looking at Shrub's statement of financial position, we know that Shrub has issued 100,000 shares. So we don't even need to plug it into a calculator. We know the ownership structure is 80%. Beautiful. Standard working 2 is your net assets of the sub working. So let's have a go at that. We need the balances as at the acquisition, at the reporting date, at the acquisition date, and the post-acquisition movement. So we take share capital, share premium, They don't seem to have a revaluation surplus, but they do have a retained earnings. So plug in the figures that we can from the question. Share capital was 100 at the reporting date, and we know it must have been the same at acquisition. So the post-acquisition movement is 0. Share premium was 30,000 at reporting date, 30,000 at acquisition. The movement will always be 0. For retained earnings, we can see that the retained earnings was 20 at the reporting date. And from note 1, they did tell us that retained earnings was 5. Don't work out your movement just yet, because we need to deal with the adjustments before we can complete working 2. So always handy to just leave a bit of space, maybe leave 5 or 6 lines, and then we can deal with set up the pro forma for working 3, goodwill. Now, because they've asked you to calculate goodwill under both the proportionate method and the fair value method, we're going to have 2 different columns. Okay, one for the proportionate method, one for the fair value method for calculating our goodwill. Goodwill is calculated as your consideration transferred. Add on the non-controlling interest at acquisition. We're doing this under both the fair value method and the proportionate method, so I'll just leave that as add the NCI at acquisition. Knock off 100% net assets at acquisition to get the goodwill at the acquisition date, from which we need to deduct all impairments to date, and that will get you goodwill at the SFP date. Whilst we're here, we can add a few easy numbers. Okay, consideration transferred was 180. Okay, where does this number come from? Well, it is the investment at cost line in the parent's SFP. Okay, so we'll leave that blank for now, and we will come back to it later. Standard working 4 is going to be your non-controlling interest. Now, there are actually 2 methods for calculating the non-controlling interest, one under the proportionate method, one under the fair value method. So, under the proportionate method, it's a lot easier. We simply take the NCI percentage, so that's 20%, and we multiply it by the net assets at the reporting date. So leave that blank. We will come back to it shortly. Under the fair value method, okay, we've got a few extra lines to consider. We must start off with the NCI at acquisition, at fair value, and then we add the NCI share multiplied by the movement in the net assets of the sub since acquisition. Okay, so we'll leave that blank for a minute. We can do it after we've had a go at working 2. We then deduct the NCI share of any goodwill impairments. So that's 2 methods, the proportionate method and the fair value method. Standard working 5 is your group retained earnings. And again, we want to calculate this based on both the proportionate method, based on both the proportionate method and the fair value method. So we take 100% of plant's retained earnings, which weirdly enough in the question is 0. And then we take the parent share multiplied by the movement in shrubs retained earnings since acquisition. So we'll leave that blank for now. We'll adjust for it in a moment. We then need to deduct any goodwill impairments. Beautiful. Just give you a moment to finish jotting that down, and then we will have a go at dealing with all of the adjustments. Okay, I'm ready to deal with the adjustments. I hope you are too. So you may want to test your understanding one in front of you, get all the notes in front, because we're going to go through each of them one by one. So note 1 told you about the balances at acquisition, so we've dealt with note 1. Note 2 tells you about the cash in transit, and luckily we've already dealt with the double entries, haven't we? So when it comes to the cash in transit, we said the adjustment was to pretend like the cash had been received. So what we're going to do is debit cash 2,000. And we are going to credit receivables by 2,000. Okay, so can you see we've reduced receivables, we've increased cash. Okay, and now the intercompany balances between plant and shrub should agree. We can therefore cancel out the payable with the receivable. So on my payables line, I am going to knock off 6. That's a debit to my payables, and I'm going to credit receivables 6. And now I've dealt with the cash in transit. Okay, you don't need to, unless specifically asked, you don't need to show the double entries. You just need to put the adjustment in the correct place in your redrafting. Beautiful. Note 3 was your PERP adjustment. We had calculated there was a £2,000 PERP, and we know that the subsidiary was selling to the parent, so we need to adjust the subsidiary's net assets, don't we? The subsidiary's retained earnings. So we go to working 2, and we're going to have an adjustment here for the PERP. We'd already calculated that, remember, as 20,000. I'm just going to show the calcs again. 20,000 times the 10%. So I'm going to have a PERP adjustment of 2, because I'm rounding things to the 1,000. Make sure you show it as a negative, because we are debiting retained earnings of the sub. And we are crediting inventory on the face of the SFP. So find your inventory line. What we're going to do is knock off 2,000. And now we've dealt with note 3. Note 4 to the question tells you about this fair value uplift. Okay, so piece of equipment had a fair value 30 grand above the carrying amount. What we're going to do is reflect that uplift as a debit to PPE, which means I'm going to increase my PPE by 30,000, and I'm going to credit the net assets of the sub. And this is going to be reflected both in the acquisition column and in the SFP column. So I've got almost my next adjustment dealt with. Because we've had to uplift a value of PPE, we then need to subsequently depreciate that uplift. And remember that it's the accumulated depreciation we reflect since acquisition. So if the uplift was 30,000 and the useful life on the asset was 10 years, we have 3,000 pounds in fair value depreciation each year. 2 years have elapsed since acquisition, so my fair value depreciation is going to be 6,000 pounds. Remember, we show this in the SFP column only. Now we can tot up our totals. I get net assets of the reporting date of 172. Is that quite right? That doesn't look quite right. I get net assets of 165 as at the acquisition date, and my post-acquisition movement is going to be 172 minus the 165. Well, that's going to be 7, isn't it? So now I've got my net asset values. I can go about completing the remainder of my standard workings. So let's take a look at goodwill. So under the proportionate method, we're going to calculate the non-controlling interest as 20% times the net assets at the acquisition date. So that's going to be 20% times the 165 we'd calculated from working 2. I am just going to do 0.2 times 165. Maybe that's easier. And that will give me a NCI value of 33 under the proportionate method. Okay. Knock off 100% of net assets at the acquisition date. We get our goodwill at acquisition of 48. Knock off your goodwill impairments to date. Well, they did tell you that in the question. Okay, they did tell you that goodwill had been impaired by £5,000. So my goodwill at the SFP date under the proportionate method is 43. Let's compare this to the goodwill figure under the fair value method. Well, the only difference is in the second line. Okay, and that's why I'm going to highlight that, I think, in light pink. Under the fair value method, we measure the non-controlling interest not as simply its share of net assets of the sub, but we also include the NCI share of goodwill. In the question, in note 5, they do tell you the fair value of NCI was 135. From this, we knock off the net assets at acquisition. So our goodwill at acquisition is, in this case, 50. Knock off the impairment. And my goodwill at the year end under the fair value method is going to be a little bit higher. It's going to be 45. And you'll find that's always the case. Okay, almost always the case. The fair value method will give you a higher balance for goodwill. It will give you a higher balance for the non-controlling interest. Under the proportionate method, so the NCI is measured as, just had a question on the chat panel. Could you explain again why goodwill at acquisition is 50? Of course. So what we're doing here is summing the above. If we go back to the question, it does tell you in note 5 that the fair value of the non-controlling interest at acquisition was £35,000. They have to tell you that in the question. And that is, in a nutshell, the main difference. That is why we have, this is the main difference between our two methods. So you can see, under the proportionate method, this 33, that is only the NCI share of the net assets. Under the fair value method, we have a higher figure because that difference, that 2, must reflect the NCI share goodwill. So we've got our goodwill figures. We use them to calculate the NCI balance. So under the proportionate method, there's not really any issue. We take 20% times the net assets at the reporting date. That's going to be 28% times 172. That gives me NCI of 34. Okay, if you wanted, you could even expand and show it to one decimal place. Under the fair value method, we take the number per the question of 35. We then take 20% times the movement in net assets since acquisition. I believe we said that was 7 from working 2. So that is going to give me 0.2 times 7, or 1.4. We then take 20% times the goodwill impairment. Well, they did tell you in the question the impairment was 5. So notice that the non-controlling interest under the fair value method gives me a slightly higher number of 35 as opposed to 34.4. I'm aware it's 1:08. Don't worry, we are nearly there, guys. Just need to calculate group retained earnings. So we take 100% of the parent's retained earnings, which is 0. And then under the proportionate method, we take 80% times 7. That is going to give me 5.6. And then we deduct the entire goodwill impairment. Because under the proportionate method, that goodwill figure is the parent's goodwill only. As such, any impairments on that goodwill are allocated entirely to the parent. I therefore get consolidated retained earnings under the proportionate method of 0.6. Let's compare and contrast that to the fair value method. The parent share of post-acquisition retained earnings remains the same. It's 5.6. But when it comes to the goodwill impairment, notice that we only take the parent's share of the goodwill impairment. So I'm taking 80% of that 5 impairment. That's going to knock off 4 and give me a consolidated group retained earnings figure under the fair value method of 1.6. Okay, so notice the difference here. I'll just put my calculation in brackets. That was 80% multiplied by the full goodwill impairment. Beautiful. Once you have those figures jotted down, we can go back and update our statements. Okay, so when we've got our total assets figure, just plug that same figure as your total equity and liabilities. I promise you it'll make your life easier. We're just going to force them to balance. And then we add up the other remaining amounts. So retained earnings was 0.6 under the proportionate method. You may need to expand your decimal places. It was 1.6 under the fair value method, we said. NCI was 34.4. Or 35.4 respectively. Okay, well done guys. So we have just done our first consolidated statement of financial position. Okay, we are back in business. Let's just do a quick sound check, team. So maybe share with me, what did you have for lunch? What was on the menu this slightly better afternoon? I had a slice of toast with some hummus and sun-dried tomatoes on top. You did not have lobster, really, Jack, did you? That's quite extravagant for a Monday afternoon. I'm quite jealous. What else was on the menu for everyone else? Cheese toasty? Okay, yep, that looks more believable. Hope that was a nice cheese toasty. I'm on my second coffee for the day. I am an addict. I have an addiction to caffeine. It's very difficult to get away from it, but it's half decaf, so I'm trying slowly to wean off. Potato dauphinoise, ooh, very fancy from Thurston. Any other contributions? What did we have for lunch today? Tuscan chicken. That does sound good. You eat well, those of you that are sharing. Hot crust buns. Hot crust buns, very fitting. Thank you, Felix. Okay, so I'm happy you four can hear me. So hopefully I'm not talking out into the ether. Whilst we wait for everyone to just join in on the call, I don't know what a Muger is, actually. Xiaona, I hope I'm pronouncing that correctly. I don't know what a Muger is. Perhaps you can enlighten us all. Whilst we're waiting for everyone else, just a sandwich from Patrick. Okay, good stuff. Okay, so it looks like I get the feeling we're having the class slowly join us. Whilst they do you remember this morning when we were going over chapter 1, I talked about how in this current unprecedented situation we are in, it'll be very interesting to see what going concern disclosures companies make. Well, my husband is in the next room. He's working from home as well, and he can hear me speak very loudly. He likes to remind me. He can always hear me very loudly, and he said, oh, funny, he heard me talk about the going concern disclosures, and he forwarded me this article. Lo and behold, it was for today's FT. It says, auditors clash with directors over the question of going concern. So you can see the increased pressure from the FRC is stoking tensions between audit firms and company directors, worried about a question mark in their accounts over whether they can keep trading, known as a qualified audit, would automatically trigger a breach of lending arguments with banks and bondholders. So a very interesting time. If companies end up with a qualified audit opinion or a modified audit opinion in any way, they could get in trouble with their bankers, with their loan agreements, with their covenants. So as I said, an incredibly interesting time right now in the financial world. This has nothing to do with corporate reporting, absolutely nothing to do with the syllabus, but I thought maybe you'd be interested in such an article. It does mention your employer and a few other of the large accountancy firms. So I've shared this with you, or at least I will share it with you when I upload my notes this evening. If you wanted to have a look, it does bring audit to real life. And indeed, maybe some of you have already heard mentioned within your firms quite a few changes going on as a result of, the measures, as a result of the sort of tumult we're seeing the economy go through at the minute. Anyway, as I said, it's got nothing to do with corporate reporting. I thought you may be interested, so I will share that. It will be shared at the end of the day on my Kaplan. What is relevant to your syllabus is what I will be covering in the next session. So just to manage expectations, we do have quite a fair bit left to go on this chapter. So if you bear with me, okay, I hope to get through all of the points listed on the board for this session. We've got another session after the next break. So we're looking more around the 5 o'clock finish time, just so you all know what we're working towards. So first thing on my list for this session is on goodwill and impairments. So if we jump back to our workbook and pick up where we left off, so that was page 37, in case anyone has lost their page. The next section looks a little bit more intimately at standard working 3, the goodwill, and in particular, this top line called the fair value of consideration. So it says that consideration could be in the form of cash or shares, which could be paid now, immediately, sometime in the future, or indeed could be contingent upon future events. Well, guess what? We did all of that. If you remember this page we drew up earlier, we already talked about all the kinds of considerations. And not only that, we already dealt with the double entries to account for these different forms of consideration. So the good news here is that there's nothing left to do. Okay, we've already done it. Woohoo! The only thing I have to add on top of the notes we've already made on goodwill is that when it comes to any acquisition costs, so any broker's commissions, any professional fees as part of acquiring your investment in the subsidiary, well, any costs directly attributable to the acquisition of the sub should be recognized in the statement of profit or loss of the group accounts. Debit P&L, credit cash or payable. Done. Otherwise, we've dealt with absolutely everything else on this page. So I ask you to please skip forward a page. Skip forward a page, and we go on to test your understanding too. So we are asked here to calculate the goodwill arising on consolidation. Sorry, not on consolidation, on acquisition. So this question has a series of different forms of consideration, and it also tells you about a fair value uplift that occurred on the subsidiary as at the acquisition date. Okay, remember that any fair value uplifts impact your net assets at acquisition and thus impact your goodwill calculation. We've got the various types of forms of consideration. I'm going to give you 3 minutes. 3 minutes. You may need to go back and use these notes to help you out here. Please, can you have a go at test your understanding 2? Okie doke. So that was your 3 minutes up. I asked you to have a go at calculating goodwill. So in this question, key thing we needed to observe was that there were two types of consideration to acquire 90% of this subsidiary. So 3 million ordinary shares were to be issued at the acquisition date. So it's shares issued today. And as well as that, we have an additional 1 million shares to issue in the future if revenues increased by 10% in 2 years' time. The fair value of each share as at the date of acquisition was £7. So indeed, that is the value we are going to take for the value of the shares, both the shares payable now as well as the contingently issuable shares. Okay, the contingently issuable shares, because it says if revenue increases by 10%, that means it's contingent consideration. It's based upon some future outcome. We take the market price today being £7 for both forms of consideration. They value the NCI under the proportionate method or the proportion of net assets method, and they also tell you about a fair value uplift of £2 million. So let's think about what's going on here. If the net assets of the subsidiary were 18 million as at the date of acquisition, or at least the carrying amount of the net assets were 18 million, and we had a fair value uplift of 2 million with relation to this building, well then the fair value of the net assets as at the acquisition date, 20 million. That is relevant because it is going to feature in my standard working 3, which is what we do below. So here we've got our goodwill calculation, 3 million shares at £7 each, plus the 1 million contingently issuable shares also at the current market value, okay, at the current market value, which we equate to be the same as fair value. Add on the NCI share of net assets at acquisition, that's 10% of the 20 mil, knock off the full 20 mil, and we should get goodwill at the acquisition date, £10 million, or 10,000 because I've rounded. Okay, beautiful. Moving on, the next section we're going to look at is all about the impairments of goodwill. So this is really covered by your IAS 36. That's your standard on impairments in general. So what you may remember from back in your FAR days is that entities need to perform impairment reviews on their assets wherever it seems like the carrying amount of that asset is greater than the recoverable amount. Okay, you may remember that from back when we looked at PPE as part of FAR. So where we conduct an impairment review, we compare the carrying amount of the item we're looking at as per the financial statements with the recoverable amount. Your recoverable amount is defined as the higher of your value in use and your fair value less cost to sell. Your value in use is calculated as the present value of all the future cash flows associated with the asset. Okay, so if you kept it into the business, what would be the net impact? Okay, what would be the overall impact in my increase in sales? We look at all of those increases or decreases, whatever they may be, discount them to present value, and that's the value if we kept the business for use in the business. If we kept the asset for use in the business. Your fair value less cost to sell is exactly as it sounds. It's how much can you flog it for. The recoverable amount is always the higher because that is what any sensible business person would do. Okay, I can either keep the asset in my business and get value out of it of 10 million, or I can sell it for 15 million. What you're going to do, you're obviously going to take the higher. So we know how to conduct an impairment review. Now, the problem is that when it comes to goodwill, and now we're specifically looking at the idea of impairing goodwill. Well, goodwill cannot be considered in isolation when performing an impairment review. It's not like we can, just lift it up independent of the subsidiary, independent of everything else of the sub, look at it by itself and assess whether it has been impaired or not. Okay? So what we need to do is consider the carrying value of the subsidiary as a whole, including its goodwill and including its net assets. So we look at the carrying value of the subsidiary as a whole, and we compare it to the recoverable amount of the subsidiary as a whole. Okay? So therein lies a bit of a problem when we're doing this comparison of the carrying value versus the recoverable amount. So with the recoverable amount, as I said, we're looking at the recoverable amount of the subsidiary as a whole. When we're looking at the carrying value of the subsidiary as per the financial statements, well, we have a problem when it comes to the proportionate method. Remember we said that under the proportionate method of measuring the non-controlling interest and therefore measuring goodwill, that on the SFP, we recognize 100% of the net assets of the subsidiary, plus the parent's share of the subsidiary's goodwill. Okay? Well, therein lies the problem, because we're comparing apples and pears. You're looking at the recoverable amount of the subsidiary as a whole, but you're comparing it to all of the net assets plus only a portion of the goodwill. Okay, and that's where we've got the problem. If we're not comparing like for like, then we can't get a true reflection of any a true comparison, and therefore a true calculation of any goodwill impairment. Okay. Now, this problem only ever arises where we are using the proportionate method to calculate NCI and therefore goodwill. Okay. So it tells you in the notes, and remember, this is the proportionate method only. If we are measuring goodwill under the proportionate method, then the goodwill allocated to the subsidiary for the purposes of doing an impairment review should be grossed up to include the goodwill attributable to the non-controlling interest. Okay, that's what the note says. This ensures that the carrying amount of the subsidiary and the recoverable amount are being compared on a like-for-like basis. Okay? The additional goodwill is known as notional goodwill. It's not recognized anywhere in the accounts, but it's used purely to calculate the goodwill impairment. And the next illustration shows exactly that. Okay. So here we've got an impairment review using the share of net assets valuation method. It says CGU impairment review. So don't be too alarmed by that for the minute. You will come across CGUs later on in the course, but they stand for cash generating units. Okay, that's what CGU stands for. Okay. So let's go through the illustration. Okay, so Caesar is an 80% subsidiary of WIN. The net assets of Caesar are 370 and the goodwill is 40,000. Following an impairment review, we find out that the recoverable amount of Caesar is only 410. They use the share of net assets method. So what is the carrying amount of goodwill following the impairment review? Well, remember that this goodwill figure reflected in the statement of financial position reflects only 80% of the goodwill. Okay? We're only showing the parent share of that goodwill figure, not the non-controlling interest share. For the purposes of doing the impairment review, we need to gross up this goodwill. So if £40,000 represents 80% of the goodwill, then £50,000 must represent all of the goodwill. How did I do this? Okay, we take the 40,000 gross up, so we multiply by 100 over 80, and that will give you the full value of goodwill. And then we are able to perform a comparison of the carrying amount and the recoverable amount on a like-for-like basis. So the carrying amount of the individual assets of the subsidiary, including goodwill, are 420. The recoverable amount is 410. So you can see that overall, we've got this impairment loss of £10,000 to allocate. Okay? Beautiful. Over on the next page then, the next question is how should we allocate this goodwill impairment? Okay, what's the double entry in other words? We know we have to debit the P&L. Okay, we know we have to charge an impairment expense through our statement of profit or loss. Well, where's the credit entry going? Well, the rule is that the impairment losses should always be allocated firstly to goodwill and then to the other assets on a pro rata basis in reference to their respective carrying amounts. Okay, so there is quite a strict order of allocation of that goodwill impairment. Now, we had calculated the impairment loss to be £10,000, and the total value of goodwill, including the NCI share that we don't normally reflect in the accounts, is 50,000. So can you see the goodwill balance is sufficient to absorb all of that impairment loss? Okay, there is enough goodwill to take the hit. None of the other assets need to be impaired. However, under the share of net assets method, only 80% of the goodwill should be shown on the SFP. So the carrying amount of goodwill in the SFP will be 32,000. How did we get that? Well, it's going to be 80% of the 40,000 and an impairment of only 8%. Okay? I just want to make a couple of extra notes at the bottom, please. Okay, just to elaborate on this a little bit. So we can say that after the impairment loss, the goodwill is valued at 40,000. This represents 100% of the goodwill, okay? But because we are applying the proportionate method, we shouldn't be showing 100% of the goodwill. We should only be showing the parent's share. And as such, we are going to take 80% multiplied by the 40,000, and that equals 32,000. That should be 0. Beautiful. In terms of the actual goodwill impairment, well, we saw that the full impairment is £10,000, but the proportion we recognize in the financial statements will only be the parent share of 8,000, and that's because we are applying the proportionate method. So your double entry will be as follows. We debit group retained earnings, £8,000, and that is going to be reflected in working 2. We credit goodwill on the face of the SFP. Okay, beautiful. So these were goodwill impairments under the proportionate method. Okay, the step here, the extra step, before we can compare the carrying amount to the recoverable amount, is that we gross up goodwill, so we reflect 100%. We then calculate the impairment. We allocate it first against the goodwill, then against other assets if the goodwill balance is not sufficient enough to absorb all of the losses. And then finally, because we're doing the proportionate method, we remember to gross down the goodwill again to reflect only the parent share. In the next illustration, we have another impairment of a subsidiary, but this time using, as you can see, the fair value method. Well, under the fair value method, it's a lot easier. Okay, there's actually no problem. There's no problem when it comes to the fair value method. So let's take a look at this illustration. The net assets of Caesar are 370,000 and the goodwill is 40,000. Remember that this goodwill is 100% of the goodwill. Okay? Because under the fair value method, which is also known as the full goodwill method, the consolidated SFP is reflecting not just the parent share of goodwill, but the NCI share of goodwill. So we've got the net assets 370, the goodwill of 40. They also tell you that the recoverable amount is 400. They apply the fair value method. How would the impairment be calculated? Well, it's a straight-on comparison of the carrying amount to the recoverable amount. We know that the carrying amount, including all of the goodwill, is 410,000. We know that the recoverable amount is 400,000, and so we must have an impairment of 10, which luckily the goodwill balance is sufficient to absorb entirely. So we allocate that 10,000 impairment loss against all of the goodwill. And as such, this leaves 30,000 as the total goodwill figure. The impairment is charged to the P&L and it is allocated between the parents and the non-controlling interest share. So you can see the big difference here. Okay, the journal entry for recognizing a goodwill impairment under the fair value method is to credit goodwill the full impairment, but then allocate that impairment against working 5 and working 4, pro rata the parent and the NCI share. Okay. Lovely. Now, going back to my plan then, we can knock off the first bullet point from our list. Next step, let's take a look at the consolidated statement of profit or loss. Okay, so another whiz down memory lane. Right, so here we have our pro forma for the consolidated statement of profit or loss for the year ended 31st December. So remember, the P&L is a dynamic statement. It shows all of the income minus all of the expenditure for a given accounting period. Now, a consolidated P&L looks pretty much like a single entity P&L. Okay, we've got all of your income minus all of your expenses to give you the combined group's profit after tax. Okay, now up until here is pretty much the same as for a single company P&L, but the difference between a single company P&L and consolidated is this little attribution statement below. So once we've calculated the group profits after tax, we need to allocate this profit between the parent company and the non-controlling interest. Because remember, assuming we don't have a wholly owned subsidiary, even though we are consolidating all of the income and expenditure of that sub, we don't own that overall profit of the sub. Okay, we only own the parent's share, and so any portion of the subsidiary's profit after tax that belongs to the other guy, to the non-controlling interest, well, that needs to be indicated somewhere in the statement. So we do this little attribution statement below. Okay, so what we're saying to the shareholders is don't get too excited. Yes, that looks like a big whopping profit, but not all of it belongs to the parent or to the owners of the parent. Some of it belongs to the NCI. Okay, so that's the first difference between a typical P&L and a consolidated P&L. As well as that, we do have an extra line to consider within the main body, and that's this line here, the share of profits to associates. And for that, we usually do a working for. Okay, how do we calculate it? It is literally the parent share of the associate's profit after tax. So it does exactly what it says on the tin. It could be share of the associate. It could be share of the joint venture. The accounting treatment for associates and joint ventures is exactly the same. We equity account for them. Okay. All right, so here's our overall pro forma. You may have noticed there are loads of references to working to. What on earth is working to? It's on the next page. So here we actually have 3 standard workings, or if you have an associate, but we generally have 3 standard workings when it comes to the consolidated P&L. We've got the group structure, which is the same as for the SFP. We then have our consolidation schedule and the non-controlling interest shares profit below. Okay. Now, let's go through these adjustments one by one. I'm going to turn my camera off so I can write on my screen. Okay. So it may be the case that the parent and the subsidiary are transacting with each other. So the parent sells goods to the sub. The parent recognizes revenue, the subsidiary recognizes a purchase. Well, as 2 single entities, that is absolutely fine, but on consolidation, we need to cancel out intercompany transactions. So what we do is debit revenue and credit purchases. Okay. Now the great thing is that the adjustments column should always be 0. So that's a little check for you to make sure you've done it in the correct way. Okay? So wherever we've got intercompany transactions, cancel them out. It may be the case that we have perps in the situation, in which case we need to do a perp adjustment. For inventory perps, we always reduce profits of the seller, so it could be a reduction in P's column, or it could be a reduction in the subsidiaries column. We do the same kind of adjustment when it comes to a PPE perp or a non-current asset perp. We always adjust the seller's column, so it could be the parents or it could be the subsidiaries. Okay? Other kinds of adjustments we may see are going to be goodwill impairments. Okay, so it's very possible that we have a goodwill impairment. And if so, that will impact your working to your consolidation schedule. Now, where we reflect the goodwill impairment depends on the method we use to measure that goodwill. So if we are applying the proportionate method, that goodwill impairment is allocated entirely to the parent. If we are applying the fair value method, then we allocate that impairment to the subsidiaries column. The reason being because some of that goodwill impairment needs to be attributed to the non-controlling interest. So by putting it in this column, when we calculate the overall subsidiaries profit after tax, remember we then multiply it by the NCI percentage to work out the profits attributable to the NCI. By including the goodwill impairment in the subsidiaries column, you are in effect allocating a portion of that goodwill impairment to the NCI. So it's consistent with the notes we have seen previously. One other thing to mention, when we're talking about goodwill impairments, make sure you reflect current year impairments only. Okay, so we're only looking at the current year. We're not concerned with cumulative impairments. Other things to mention from here are that you don't forget mid-year acquisitions. Okay, so where they tell you the subsidiary was acquired maybe on the 1st of March, don't forget to prorate by 10 months out of 12 because maybe we've only had the subsidiary in the group for a portion of the year. So don't forget to adjust for mid-year acquisitions. Okay. Let's carry on with the notes. So mid-year acquisitions I have just talked about. Sales and purchases I have talked about. So remember what we're effectively doing is debiting the revenue and crediting your purchases. Okay, crediting your purchases, crediting cost of sales. Okay, other kind of adjustments we can see. If we scroll forward a few pages, I've already talked about the inventory perp. I've already talked about the non-current asset perp. Other adjustments we may see are in relation to intra-group dividends. Okay, so it says that a payment of a dividend to the subsidiary will need to be cancelled out. I'm just going to go back to my notes, make sure everyone can see the comments. I appreciate I went a little bit too fast there. Let me just write that out a little bit more neatly. Beautiful. So the next issue we're looking at, we haven't talked about yet, are intra-group dividends. So a payment of a dividend will need to be cancelled out in the consolidation schedule. What does that mean? Well, here you're going to have P's column, S's column, and the adjustments column. Notice I am abbreviating to my heart's content. There are no presentation marks going for your workings. No need to make them all full and beautiful and neat. Just, save yourself time, abbreviate where you can. Now, it may be the case that the parent, let's just put a few more figures in. It may be the case that the parent has some investment income. And that is going to be a positive figure in the parent statement of profit or loss. If you then find out that investment income included dividends received from the subsidiary, well, on consolidation, that's basically an intercompany transaction, isn't it? Because if the subsidiaries paid a dividend to the parent and we treat them as a single economic unit, it's like me paying a dividend to myself. It's not real investment income. So what we need to do is make an adjustment for that. So we take a divvy from the sub as a reduction in the overall investment income. Okay? The next note here talks about intragroup interest and intragroup management charges. So it could be the case that the parent has lent some money to the subsidiary. The parent will therefore be making some interest income, and the subsidiary will be incurring some finance costs. Cancel them out in the adjustments column. Okay, so you're going to have a reduction in the investment income, a reduction in the finance cost. Remember, this should always end in 0. Otherwise, there has been a mistake somewhere. We've talked about goodwill impairments. So remember, under the proportionate method, impairments go under the parents column. Under the fair value method, impairments go in the subsidiaries column. The final bit here is on fair value adjustments. So where we have a fair value uplift on PPE or indeed on any internally generated intangibles, then there will usually arise some subsequent depreciation or amortization. The charge will go through the subsidiaries column in working 2. Okay? Always the subsidiaries column. The logic behind that is, well, if the asset sits in the subsidiaries books, then the depreciation also needs to go through the subsidiaries books. And it's important which column the fair value depreciation or amortization goes under, because it will then need to be allocated pro rata to the NCI in working 3. No one likes to go through a whole series of workings without seeing it come to life. So indeed, that's what we are going to do with the next exercise, with our Test Your Understanding 3. So let's take a look at the notes. So we've got the results of Parker and Schnabel for the year ended 31st December 2007. On the 1st of January 2006, which looks like it was 2 years ago, Parker purchased 75,000 ordinary shares at 170,000. The issued share capital is 100,000 ordinary shares. At that date, retained earnings were £60,000. Okay, and because they have 75,000 of the 100,000 issued share capital, we know the ownership is 75%. We've got income and expenditure of the parent and the sub as follows. Always good to have a quick kind of just peruse through the notes, look out for anything interesting. Notice that the parent had made dividends of 30,000, and we've got the opening and closing retained earnings balances. The following additional information is relevant. So during the year, Schnabel sold goods to Parker for £20,000. So here you've got a situation where the sub sells to the parent, making a markup of 1/3. So when they talk about markups, remember they're always talking about markups on cost. Only 20% of the goods were sold before the year end and the rest were still in inventory. Well, if 20% of the goods had been sold, then it must mean that 80% is still in inventory. So here we've got a PERP adjustment to deal with. We're told that goodwill has been subject to an impairment review, and at the end of each year, the first review last year revealed an impairment of £5,000, and the review at the end of this year revealed another impairment of £5,000. Impairment is to be recognized as an operating cost, and they measure goodwill under the proportionate method. We need to calculate a consolidated profit or loss. Okie doke. Can you all do this in your CBE software, please? The more practice we have, the better. Okay, so I'm going to abbreviate here. We've got the consolidated P&L for the year ended 31st March 2007. Make sure to expand your rows, expand your columns, so the examiner can see what you have written. Okay, so let's have a go at drawing up this pro forma. Okay, so once you've drawn up your statement, leave lovely, beautiful, clear references to your working 2 and working 3 so the examiner knows where you have got those figures from. Don't bother with all the borders and subheadings and making everything look pretty. That's not going to get you any extra marks. We're concerned with just getting the final figures in, completing the question as quickly as possible. So that's your pro forma. Don't worry about any major typos. As long as the examiner can understand what you have written, you will get credit. Below, let's draw up our standard workings. So working 1 is your group structure. We've got Parker as the parent. We've got Schnabel as the 75% sub. Okay, that's all you need to mention for your group structure. Working 2 is your consolidation schedule. So we need a column for the parent, a column for the sub, adjustments, and then your total figure. Notice there were no mid-year acquisitions, so we would consolidate 100% of the sub. No need to prorate. When it comes to the consol schedule, feel free to abbreviate as much as you like. I always think it's good practice to leave a bit of space underneath all the expense lines because you never know when you need to make an adjustment. Notice that I am not bothering with any kind of subtotal. It's just not needed for the consolidation schedule. So don't waste time calculating gross profit when you do not need to. Let's copy across all the easy numbers from the question into your answer. So 600 income for the parent, knock off 360 cost of sales, knock off 93 for OPEX, knock off 50 for the tax. Oops, 0 for finance costs, apologies, and 50 for the tax. And then we copy the same figures for the parent, for the subsidiary, my apologies. So we've got 300 income for the sub, knock off 140 in cost of sales, operating costs 45, finance costs 3, tax 32. Great, so we've got all the easy numbers in there. Now we need to deal with all of the adjustments. So the first adjustment we saw was a PERP, or indeed a PERP as well as an intercompany transaction, because we see that Schnabel sold goods to Parker for £20,000. That is an intercompany sale. What we need to do is reduce revenue by 20,000 and reduce purchases by 20,000. Where do we do this? In the adjustments column. And notice that they net off to nil, so I am on the right track. We've dealt with the intercompany adjustment. Now we need to deal with the PERP element as well. Okay? And we need to do a calculation for that. So I'm going to do another little working below. We know working 3 is the NCI, so I'll just leave a bit of room for that. Let's go over to working 4, where we calculate our PERP. So we know that goods are sold at a markup of 1/3. That must mean the cost value represents the 100%. The sales value represents 133, and the gross profit must have been 33% of that cost figure. We know the goods were sold for £20,000, so a little bit of cross multiplication and division tells me that the cost of those goods sold would have been 15, and therefore the profit would have been 5. Okay. Now, of the profit of 5,000 made on these sales, we are told that 80% of those goods remained in inventory at the year end, and as such, 80% of that profit is unrealized. So we make a provision for it. Okay, that's going to give me a provision or a PERP of 4,000. The double entry for a PERP is always to debit retained earnings of the seller, debit retained earnings stroke profits of the seller, and credit inventory on the face of the SFP. Now, in this case, we know that the seller happens to be Schnabel, the subsidiary. So this 4 is going to be reflected as a reduction in Schnabel's profits. So go up to working 2. We're going to have a PERP adjustment with the subsidiary as the seller, showing a reduction of for the subsidiary's profits. And so now we've completely dealt with note 1. They also tell you in note 2 that goodwill had been subject to an impairment review, so we do need to reflect our goodwill impairment. Which column do I reflect the goodwill impairment in? Which column do I reflect the goodwill impairment in? Parents column. Thank you very much. Okay, we have a goodwill impairment of 5. We have a goodwill impairment of 5 showing the adjustment as a reduction in the parents column. I'm just going to go back to the other double entry in case anyone didn't quite manage to get all of that down. Just had a request to go back here. So when it comes to the perp adjustment, we're always reducing the profits of the seller. I think we calculated the perp as 4K. And we reduce the value of inventory by 4K on the SFP. Luckily, if we have a P&L question, we don't need to worry about the credit entry because we don't see the inventory balance anywhere on the P&L. Lovely. I think that is us having dealt with all of the adjustments. So now we can calculate the revised profit after tax. Don't bother doing the total for the parent. It's not necessary. We are only concerned with the subsidiaries adjusted profit after tax because that impacts our standard working 3, the NCI working. Okay. So the NCI share is 25%. We multiply it by the subsidiary's profit after tax. Well, that's the 76 we just calculated from above. And that gives me profit attributable to the non-controlling interest of 19,000. Okay, or 19. Once you've got that figure, we can now complete the statement, which means you need to sum up all of your totals. Beautiful. So once we've got our totals, we can populate our actual statements. Okay, so it looks like we have consolidated profit after tax of 168. Okay, so that's the consolidated profit of both the parent and the subsidiary. But of course, not all of that profit belongs to the owners of the parent. We know we need to allocate some of it to the non-controlling interest. We take that same figure down below. We've already calculated the NCI's profit as 19,000 from working 3. So the profit attributable to the owners of the parent is going to be the balancing figure, 149. So I'll just give you a moment to finish jotting that down. I will download this as PDF and share it on my Kaplan later on today, so you will have a copy as well for your notes. Okay, lovely. In terms of our plan for this session then, let's knock the consolidated P&L out of the way. Next step, let's take a look at the consolidated statement of changes in equity. So this isn't as examined for corporate reporting because you will have been examined quite thoroughly on this back in your FAR days. But this page is a lovely, beautiful, neat summary of the key aspects you need to know for the consolidated statement of changes in equity. So remember that your statement of changes in equity is all of the equity balances rotated 90 degrees, showing the movements from the beginning to the end of the year. So we have our columns. Because we're looking at a consolidated statement of changes in equity, we've got our columns for share capital, retained earnings, and the non-controlling interest. Okay, there is a totals column here in the middle. If you remember it, great. If you don't, I doubt it'll ever cost you anything. Now, when it comes to the consolidated statement of changes in equities, remember that with share capital, we are including the parent's share capital only. You've got these nice little superscripts giving you additional notes. The share cap is the parent's only. This is consistent with what we've seen in the SFP. When it comes to retained earnings, the trickiest thing to calculate is actually the first number, okay, this brought forward balance for retained earnings. And they've given you a bit of a working here. So to calculate retained earnings brought forward, well, we do a working which is very similar to your standard working 5 for the consolidated SFP. The only difference is that we're trying to calculate the retained earnings not at the end of the year, but at the start of the year. Okay? So when we do our retained earnings brought forward, we take 100% of the retained earnings of the parent at the start of the year. We then take the parent share of the subsidiary's post-acquisition movement in retained earnings from acquisition to the start of the year. Knock off impairments to date, and that will give you your retained earnings brought forward. Sometimes it's useful to do a little bit of an extra mini working too, I like to say. Sometimes it may be necessary, and I'm just going to turn off my screen here so I can draw. Sometimes you may need to do a net assets of the subsidiary working, but up to the start of the year. So we've got our column for share cap, for retained earnings, and we're calculating these values at the brought forward date and at the acquisition date. So it's just like you're working to your net assets of the subsidiary working, but now we're only going up to the start of the year, not the end of the year. So we insert the information we have from the question, think about the typical kind of adjustments we see in working to. We may have some fair value uplifts. We may have some fair value depreciation to get our revised figures. Okay, and from that we can work out the overall movement. So it's this movement here that we take over here. Okay, it's the parent share of the subsidiary's change in retained earnings from the acquisition date to the start of the year. Okay, and that's this figure we've just calculated, this movement. We take total comprehensive income as per the P&L. So TCI is from the consolidated profit or loss. Okay, no big deal there. We knock off any dividends to get our carried forward value. Now, when it comes to dividends underneath the retained earnings column, this is dividends paid by the parent only. Okay? We don't show any dividends paid by the subsidiary within the retained earnings column. In the NCI column, okay, the trickiest number to calculate is going to be this brought forward value for the NCI. So how do we calculate that? Well, we need to calculate the value of the non-controlling interest at the start of the year. The calculation depends on whether we are applying the proportionate method or the fair value method. So under the proportionate method, we take the NCI's percentage times the net assets of the subsidiary at the brought forward date. Well, guess what? That's this figure over here. Okay? That's why a mini working 2 might be useful to you. We've got this net assets of the subsidiary as at the brought forward date. Well, we can take that figure, multiply it by the NCI share, and that gives you the NCI balance at the start of the year, at the brought forward date. That is assuming we apply the proportionate method. If we have the fair value method, then it's that extended version. It's a little bit longer than normal. We have to take the fair value of NCI at acquisition, which will, of course, always be given to you in the question. We then take the NCI share of any movement in net assets up to the start of the year. So that's this movement we've calculated in our mini working 2. Okay. That's this figure over here. We then take the NCI share of any impairments up to the brought forward date, and that gives you your NCI brought forward. We add the profits attributable to the NCI, knock off any dividends paid by the subsidiary to the non-controlling interest to get our closing figure. I'm very sad to say we don't have any exercises on the SOCI in our workbook. I'm sad, you may be very happy, goodness knows, but that means our recap of the SOCI is contained to this one single, quite nifty, quite handy page, I think, which has a nice summary of all the different inputs. So there's not much else to say with regards to the consolidated SOCI. So let's knock that off our objectives list. Okay, we've got 2 things left to go before our next break. So how to deal with associates and joint ventures, and then how to deal with a full disposal. All of this up until now is still revision from FAR. IAS, so Section 5, IAS 28 on associates and joint ventures. So where we have an associate, this is where the parent can exert a significant influence over that associate. Okay? Or if we have a joint venture, that is where each and every investor has joint control over the running of that company. Okay? Usually we say that unanimous consent is required before any key operating divisions are made. Now, regardless of whether the parent has an investment in an associate or a joint venture, in either case, the treatment is to equity account for them in the group financial statements. Equity accounting, I like to think of it as meaning that we take our share of the entity. Okay, so we take our share of, essentially the net assets of the associate since acquisition. We take our share of any profits of the associate since acquisition. And I'll be referring to associates for the rest of this page, but I could equally be talking about joint ventures. Now, you need to understand the impact of holding an investment in an associate in both the SFP and in the statement of financial position. So we'll start off with the statement of financial position. You will typically have to do an additional working to calculate that one line. Okay, so we're going to have an extra line in the consolidated SFP. We call it the investment in associates and joint ventures. So that is included as part of your non-current assets. Okay, it'll be included as part of the non-current assets section. This is usually working 7. Could be another working, but let's just call it working 7. And the way we calculate our investment in the associate is to start off by taking the original cost of the investment. So how much did P pay to acquire the associate? We then take the parent share of the associate's profits since acquisition. We knock off any impairment losses on the associate to date. This will always be given to you in the exam. And that will give you your closing value for the investment in the associate. Okay? Beautiful. That's all. That's as far as we go there. And this is the treatment in the statement of financial position. In the statement of profit or loss, what we must include is the parent share of the associate's profit after tax. So this is typically, let's call it working 4 as part of your consolidated P&L workings. We take the parent share times the associate's profit after tax. So not much more else to say there, except that we do then need to deduct any and all impairment losses on that associate for the current period. Okay, so it's for the current period only, and that gets you income from the associate or joint venture. We've got some other key points to mention with regards to associates. So transactions between the group and the associate should not be cancelled out. Okay, so let's think about what's happening structurally here. Here is the parent, here is the sub, and outside of the group sits the associate. Because it is genuinely outside of the group, it means that any intercompany sales need to remain in the consolidated accounts, okay? Because it's a true transaction from within the group to outside the group. As such, intercompany transactions should not be cancelled out. However, we do need to adjust for perps, okay? So where we've got an associate or a joint venture perp, make sure you're happy with the double entries. Okay, the double entry is always to debit your group retained earnings, which is reflected in your standard working 5 if you were doing the SFP. And we credit either inventory if the associate is the seller, or we credit the actual investment in the associate if the parent happens to be the seller. Okay, and that would be reflected on the face of your SFP. Now, how do I remember that double entry? Well, I always ask myself, where are the goods sitting? Okay, so if the associate had sold goods to the group, then the goods would be sitting within group inventory. Okay, and it's the inventory that's overstated, so we credit inventory to reduce that value, to reduce it by the perp. If the group had been selling to the associate, then we can't credit inventory because it's not within the group. Okay, we sold it somewhere else. So all we can do instead is to credit the actual investment in the associate, because it is indeed within the associate that the goods are held. Now, one other thing to mention with regards to perp. Okay, so I just like to add an NB here. When it comes to associate or JV perps, calculate the perp as normal, and then multiply by the parent's percentage. Okay, so this is the mousetrap that candidates always fall under. Where we have a joint, an associate or a joint venture perp, candidates are excellent at calculating the perp because we know how to do that. We work out the profit multiplied by the goods remaining at year end. That gets you the perp. But where the perp is in relation to an associate, you then need to multiply it by the parent's percentage. So don't forget that bit. I've just had a question here on how to deal with in-transit items for joint ventures and associates. Doesn't really come up. It doesn't come up, in fact, so you don't need to worry about that. Okay? Perhaps our beautiful teaching assistants can offer a little bit more, but it's really outside of the syllabus, so I wouldn't worry too much there. Now, where are we in terms of our plan? Well, there is a little bit more on joint arrangements, but I would say just read this at home. Ooh. Read at home. We're going to move on to disposals. Okay, so with joint arrangements, they just give you a little bit more detail on what actually is a joint arrangement, but the accounting we've covered, and the accounting is what's important. Last thing to cover in this session then, before we take our next break, is a disposal. Okay, a full disposal. And indeed, this is something we have seen in the past from back in FAR. We have dealt with how to deal. We have dealt with the disposal of a whole subsidiary. So what happens if you get rid of all the shares in your sub? Okay. Well, in the consolidated statement of profit or loss, what we need to do, and it's listed bullet by bullet here, is to time apportion the results of the subsidiary up to the date of disposal. We also time apportion any profits attributable to the non-controlling interest. On the date of disposal of the subsidiary, we need to calculate a gain or loss, which is included within the consolidated profit for the year. Now, back in FAR, it was always stated in the exam question that the disposal of a subsidiary constituted a discontinued operation under IFRS 5. Okay, Now, if it is the case that the subsidiary is indeed a discontinued operation, as defined under IFRS 5, then what you would have is an extra line. You would have one extra separate line in the financial statements called profit from discontinued operations. And that would be calculated as your profits of the sub up to the disposal date plus the profit of the sub on disposal. And that would represent one extra line, okay, one separate line in your consolidated P&L, profit from discontinued operations, okay? But one important thing to notice here is that at the advanced stage, it's not always the case. To qualify as discontinued, the subsidiary must represent a separate major line of business or geographical area of operations to that group. Okay, so we cannot necessarily assume that by getting rid of a subsidiary, it counts as a discontinued operation under IFRS 5. Okay, so just a little bit of a note on that. But otherwise, let's go ahead and deal with the accounting. So where we've disposed of a subsidiary, we need to calculate the profit on disposal of that subsidiary. How do we do that? We compare the proceeds received on disposal to the carrying value of the subsidiary at the date of disposal. Okay, so the calculation is written here. We take the sales proceeds, and from it, we deduct the carrying amount of the subsidiary at disposal. That carrying amount consists of the net assets of the sub plus the goodwill at disposal minus the NCI at disposal. So we compare one number to the other, and that difference is going to be your profit or loss on disposal. You will need an extra working to calculate the net assets of the sub at disposal, the goodwill at disposal, and likely the NCI at disposal as well. So usually it requires a working within a working within a working to complete this style question. Okay, so we are going to have a go at the next test you're understanding. That's TYU4. Just give you a moment to finish jotting down the notes, and then we'll have a look at it together. Okay, TYU4 then. We are asked to calculate what is the profit or loss on disposal in the group accounts for the year ended the 31st of December. Kingdom acquired 80% of Westville on the 1st of January for $280,000 when share capital was $100,000 and retained earnings were $188,000. So what they're doing here is giving you the balances as at the acquisition date. On this date, the fair value of the NCI was 67. Kingdom's policy is to apply the fair value method with regards to measuring NCI. Goodwill has suffered no impairment since acquisition, which is great. It makes our life easy. On the 30th of June, Kingdom disposed of its investment for proceeds of $350, and we've been given extracts as follows. So we've got retained earnings brought forward for the sub, profit for the year, and we're told a dividend of £10,000 was paid on the 14th of March, which has not yet been accounted for. Notice that the 14th of March is prior to disposal. Okay, the 14th of March is prior to disposal. So we need to calculate the profit or loss on disposal in the group accounts. Let's get a clean sheet of paper out to have a go at that. And by the way, guys, all the exercises, all the test your understandings in this workbook, and especially in this chapter, are to be very useful to you. I would recommend when you draw up your notes, make them very neat and clear and easy to refer back to. Okay, I'll show you a little bit later. Quite often there are technical aspects to a CR question that the workings for which are very similar to what we do in the workbook. Okay, what do we do in these test your understandings? So make sure everything is clear and lovely and neat and clearly labeled so you can refer back to it. Okay, so we are dealing with a full disposal. So we set up our working, we'll call it working 1 for the profit on disposal of the sub. So we insert our proceeds as at the date of disposal. They told you that was £350,000, from which we deduct the carrying amount of the subsidiary as at the date of disposal. And that is going to consist of the net assets of the sub at disposal, for which we're going to have to do a working. Okay, so leave a reference to working 2. We deduct the goodwill of the subsidiary as at the date of disposal. And for that, we're going to have to do an additional working 3. And we adjust for the non-controlling interest, for which we'll have to do a working 4. So I wasn't kidding. We've got a working within a working within a working. That should give you the carrying amount of the subsidiary at the date of disposal, from which we can work out any profit or loss on disposal. So all we have so far is the proceeds. Okay, we need to work out all of the other elements before we can complete working 1. So let's have a go at that. My working 2 is going to be the net assets of the sub at the date of disposal. Well, we've already discussed what net assets are. Net assets are your assets minus liabilities, okay, which amounts to the same as equity. And equity is, of course, your share capital and your retained earnings balance. Okay, your share capital and your reserves balances. So they tell you in the question that share capital was 100,000. And we now need to add the retained earnings balance as at the disposal date. They haven't given it to you. But we had that fun game in calculating retained earnings, didn't we? So we know exactly what to do to get the RE balance at the date of disposal. We've got the retained earnings brought forward, which they did tell you in the question. That was 215,000. And to this value, we need to add profits up to the date of disposal. The disposal date was the 30th of June 2008. Okay, so we have 6 months worth of profit to add on to the opening balance. The profit to disposal Well, that's 6 months out of 12. That takes us to the 30th of June. And we multiply that by profits for the entire year. I think that was 24,000 per the question. That's going to give me 12,000 in profit up to the date of disposal. We're almost done there. Is there anything else I need to adjust for? What else do I need to adjust for? Dividends, very quick off the mark. Thank you, Samuel. You're absolutely right. Those dividends had been paid in March, earlier on in the year, and therefore need to be accounted for. They tell you that it hasn't been accounted for yet in the notes. So remember, dividends would reduce the value of the net assets of the sub because we're debiting retained earnings, crediting cash, and that will give you net assets of the sub at disposal of, let's have a look. I can probably do that in my head. It's 317,000. Beautiful. Now we have that figure, we can transfer it all the way up to my working one. Okay. Next step, we calculate goodwill as at the date of disposal. So let's draw up working 3 for goodwill. The good news here is that you already know how to calculate goodwill because we've done it a few times today already. We start off with the consideration paid to acquire the subsidiary. Going back to the notes, Kingdom acquired Westville for £280,000 some years ago. We then add the non-controlling interest at acquisition. They do tell you in the question that the fair value method is applied. So we take the fair value of NCI at the acquisition date, 67,000, and we deduct 100% of the net assets at the acquisition date. Well, net assets is going to be your share cap plus any and all other reserves. They do tell you in the question that share capital was 100,000, and they tell you that retained earnings were 188. So my goodwill at the date of acquisition would have been 59,000. And guess what? They do tell you that goodwill has not been impaired. So that's good news. Okay, we don't need to do anything further to this figure. We just transfer it all the way up to your profit on disposal working. Just give a moment for everyone to finish jotting that down. All the way up. Knock off 59,000. And then the last thing to adjust for is the non-controlling interest. Okay, so we need to do an extra working for that. Yes, one more working. Okay, feels like it never ends, but I promise you this is the last extra working. We want the non-controlling interest at the date of disposal. So we start off with the fair value of NCI at the date of acquisition. I think they told you that. Okay, that was 67,000. And then we need to add to this the NCI percentage multiplied by the change in net assets from acquisition to the disposal date. Well, let's think about what's going on here. Okay? And we've actually already calculated the numbers. We need to know the net assets of the subsidiary at the date of acquisition. Well, we know that figure already, don't we? It's the 288,000. Okay, that's your 100,000 in share capital plus the retained earnings at the date of acquisition. And since then, we need to know what has happened to the net assets of the sub. Well, we've already calculated that as well, because we know what the net assets of the sub were at the date of disposal. It was 317,000. We've already calculated it from working 2. So my working 4 is going to be 20% times the movement in net assets since acquisition. So we take the net assets at disposal, knock off the net assets at the acquisition date. Okay, that gives you the movement in the net assets, multiply it by 20%. That should give you 5,800. So your NCI balance at the date of disposal is 72,800. Once you've got that final figure, copy it across to your profit on disposal working. Remember, it is the opposite sign. It is the opposite sign to the other 2 entries. Ooh, pardon me. So overall, we are going to be knocking off, if I plug this into my calculator, 317 plus 59 minus 8. We're going to knock off 303,200. And that gives me, what does that give me? 350. 46,800 as my profit or loss on disposal. If that felt like a lot of work to get one number, then you won't be wrong here. That is indeed a lot of work to get one number, but this is how you calculate it. It's very formulaic. Okay, this is the only way you can calculate it. So now you've got one really beautifully neat example. Okay. It's about as technical as a full disposal gets. So you've got it in your notes. You're going to have it nicely organized, nicely tabbed up, so you know exactly where to go if this kind of transaction takes place in an exam question. Okie doke. We do have more to deal with on disposals, but this is all new stuff. Okay, this is all new stuff from for CR, so I think now is a good time to take a break. A lot of new stuff going on here. Get up off your chairs, have a stretch, get a cup of tea. I'll leave the workings on the board. I'll zoom out a bit so you can see it a little more clearly. Hopefully that's visible to everyone. And I will see you all at, let's say, 3:45. Okay, 3:45, and we've got quite a chunky session to get through for the last push of the day. Okay, 3:55, so welcome back everybody. Before we continue, I have a correction to make to the notes I had done for the previous Test Your Understanding. Jack, who claims he is not an auditor, still has some mad skills when it comes to auditing my work, so thank you for identifying that. When we calculate the value of the non-controlling interest at disposal, the second line is to take 20% of the change in net assets since acquisition. It should be 317 minus 288. My apologies for that. I forgot to consider the share capital, which was, of course, valued at 100,000 at the date of disposal. So just make sure, go back to your notes, update your standard working for, and let's all thank Jack, who, as we all know, should immediately transfer to audit. Okie doke. So the plan then for the rest of the afternoon, okay, is to deal with all of the new stuff. Can you believe up until now we've simply just been revising things from financial accounting and reporting? So this is all your bread and butter stuff we have been doing up until now. For the next session, and to be frank, it's going to be going past 5. It's going to be going past 5, but I know none of you have plans this evening to go out. So that means we can spend more time together in the virtual room getting over all of these new topics for corporate reporting. In particular, how do we deal not just with the disposal of a subsidiary, but with an associate? And then how do we deal with partial disposals? So maybe we had 60% and we've now gone down to 30%. Okay, well, there we've got a change in status of the investment, don't we? We're going from a subsidiary to an associate. How do we deal with that and other variations of these kind of partial disposals? How do we deal with step acquisitions where we're going the other way? Okay, so we had 10%, now we've got 30, now we've got 60. How do we account for that? A little bit on disclosures, I'll keep that brief. A little bit on consolidated statements of cash flows, again, I'll keep that brief. And then the audit and assurance of groups. Okay, so I will spend a bit of time on that. It's significant for your paper. So let's jump back into the notes. What we had done was deal with the full disposal of a subsidiary. Next step, we deal with the full disposal of an associate. Okay, and I can see in the chat panel, yep, Rafi hates cash flows so much, you and everyone else. Okay, but don't worry, all right? You know, you've done cash flows to death for FAR. It's not as in-depth for CR. Even if it is, you can definitely have a stab. It's an open book paper. Okay, it's an open book paper, so you're going to have all of your notes there. Rob loves cash flow, so you can keep him busy with all of your queries day and night. Okay, if there was, you know, any question you saw. And he will indeed teach you everything he knows. Okay, let's deal with the full disposal of an associate. So where we've disposed of an associate, we need to remove that investment in associate line from the statement of financial position. So at the year end, there's nothing to worry about. We've disposed it. Don't need to bother reflecting any balance. In the consolidated statement of profit or loss, what we need to do is calculate a profit or loss on disposal. Okay, so and how do we calculate that? We compare the sales proceeds to the carrying amount of the associate at the date of disposal. I think it's nice sometimes just to have the double entries so we all know what's going on in the situation. Okay. I am an accountant. Okay, I love my debits and credits. If I don't know the double entry, then I'm not 100% satisfied. Where we've disposed of a subsidiary, we have received cash in exchange for our shares in that associate. Sorry, I said subsidiary. I meant associate. So we've received some cash. Let's debit some cash. We've disposed of the investment in the associate. So we credit the investment. And whatever is left over, that balancing debit or that balancing credit is going to be a gain or loss in the statement of profit or loss. We calculate that as the balancing figure. So that's the double entry. That's what's really going on here, okay? And we've got your pro forma, or we've got the disposal calculation. Hey, your investment in the associate is comprised of the original cost of the investment, which they'll have to tell you about, plus the parent's share of any post-acquisition profits up to the date of disposal. Knock off any impairments to date. So TYU5, full disposal of an associate. Berry acquired 30% of Hollywood for £150,000 when the share capital was £50,000 and retained earnings were 65. So these are details about the acquisition. On the 1st of July, Berry disposed of Hollywood for proceeds of $310,000. We have extracts as follows. So we've got retained earnings brought forward for the year. We have the profit for the year. I would like you to have a go at this question, please. And I'm not going to give you very long at all. Okay. I will write out the pro forma. Please, can you calculate what the profit or loss on disposal is? So some of you have already got there, but I'll just give a couple more minutes so everyone else can have a go. Okay, some of you are super speedy. Just give a chance for everyone else to catch up. So you have a go. What is the profit or loss on disposal? Okay, right. So I'm only just catching up with everybody else. So well done to Silong, well done to Sabine for calculating the profit on disposal, and indeed it is a profit of 119,500. So we draw the working as follows on the board, copying the pro forma from the question. We know that proceeds were 310,000, and from that we remove the carrying amount of the investment in the associate. That carrying amount would have been its original cost of 150,000 plus the parent's share in the change in net assets of the associate since acquisition. How do we calculate that? Well, we know the acquisition net assets would have been 65,000. Okay, so we know the acquisition retained earnings would have been 65,000. It's mentioned to you in the question above. We need to calculate the value of retained earnings at the date of disposal. So I've done that in the notes above. We take opening retained earnings plus 6 months worth of the profit to get you up to the 30th of June. That gives you retained earnings at the date of disposal of 200. So we've got the overall movement of 135 times the parent's share to give you the post-acquisition profits. We've got the total carrying amount of 190. Take that off the proceeds, and your gain is 119.5. Debit cash, 310. Credit, the investment in the associate. And in this case, credit, the statement of profit or loss, by your gain, 119,500. Okay, so just give you a moment to finish jotting up those notes. And that covers the full disposal of an associate. So now we know how to deal with the disposal of a subsidiary and an associate. You've got your workings, you've got your nice, neat test your understanding here. Make sure it's all written up beautifully, neatly, so you can always refer back to it. Moving on, now let's think about partial disposals. So where we currently have a subsidiary and then we sell some of the shares. Well, it may be we sell some shares but still retain control. Maybe we're going from 90% down to 80%, so we've got a sub, and then we've got a smaller sub. It may be we go from a sub to an associate. It may be we go from a sub to an investment. So we've got a series of variations, a series of scenarios to consider. The first section we're going to go through is from a subsidiary to a subsidiary. So let's say we're going from 80% down to 60%. Well, in this case, okay, here is what you need to know. There is no gain on the disposal. Okay, there's no gain on the partial disposal. There is no adjustment made to the carrying amount of goodwill. Goodwill is something that arises on acquisition, okay, and we do not adjust it except for subsequent impairments. But we would never go back and recalculate that goodwill. So that remains as is from the date of acquisition. You do not touch it. The difference between the proceeds received for our partial disposal for the shares we've sold off and the change in the non-controlling interest is accounted for directly within shareholders' equity. So we record the cash proceeds, credit the NCI, and then the balancing figure will go to equity. Okay? And of course, we're crediting NCI because that makes sense, doesn't it? If we are going from 80% down to 60%, as in with this example, then the NCI percentage must be going from 40%, other way around, from 20% up to 40%. So the NCI balance must increase. If our shareholding gets smaller, the non-controlling interest shareholding gets bigger. Okay? So this is an extra new adjustment we have to learn, and we're going to see it in the next test your understanding. In the statement of financial position, we calculate the value of goodwill at the end as normal. We consolidate the results of the sub as normal, and we calculate the non-controlling interest by reference to the year-end percentage. So in this case, if we're going from 80% to 60%, then the NCI percentage at year end must be 40%. We calculate goodwill as at the original acquisition date minus any impairments. We do not adjust the goodwill as a result of any partial disposal. Okay, and we post that double entry adjustment we've just looked at. In the statement of profit or loss, we continue to consolidate the sub for the whole year. We calculate the non-controlling interest on a pro rata basis. So what that means is we would take the NCI the original NCI percentage times the subsidiary's profit after tax up to the date of partial disposal. And then after that, or in fact, let's just write a little note here. We can say we take the old NCI percentage times subsidiary's profit after tax up to the partial disposal. And then we take the new NCI percentage times the subsidiary's profit after tax from the partial disposal to the year end. Beautiful. Now, let's put all of this into practice. Okay, we're going to have a go at Test Your Understanding 6. We are asked to prepare the consolidated statement of financial position as at the 31st of December. Now, this one I am going to do handwritten because it's brand new to us. Okay, so please, can you get a clean sheet of paper out? Nice and neat. Get your best handwriting. We're going to have a go at TYU 6. Going through the information, we need to prepare the consolidated SFP. Express acquired 90% of Billings in 2002 when Billings had retained earnings of $250,000. Goodwill at acquisition is calculated as 45 using the proportion of net assets to value the NCI. Goodwill has been impaired by $5,000 since the acquisition date. We have extracts for 2008 as follows. Okay, so you've got assets, equity, and liabilities. Notice that where they've given you the equity session, they've given you retained earnings brought forward, and then they've told you the profit for the year. Okay, so they've presented it slightly differently. Express disposed of a 10% holding in Billings on the 31st of August for £70,000. This has not yet been recorded in the accounts. So it looks like we're in a situation where we started off with 90%, we sold 10%, so now we have an 80% shareholding in Billings. Okay, so we're going from 90 to 80. It's still a subsidiary down to a subsidiary. And if we look at the dates, so we had 90% for 8 months out of the year, from January to August, and then we had 80% for the remainder of the year from September down to December. Okay, so let's have a go at Test Your Understanding 6. So, first things first, wherever we're asked to draw up a statement, let's start off by drawing up that statement. This is the consolidated statement of financial position as at the 31st of December 2008. So let's start off by copying out the line items from the question into my pro forma. And we can open up our brackets, copying across 100% assets and liabilities of Express and Billings. Remember, they're very kindly given you the goodwill figure as at acquisition, so we don't need to calculate it. Okay, so if you have gone this far with me, then what we have done is get all of our easy marks. Okay, so we have collected our 100% assets and liabilities. What we have left to do is deal with calculating the closing year balances for goodwill, group retained earnings, and the non-controlling interest. Okay, so let's go through those one by one. Now, with goodwill, they've been very kind to us. They gave you the value for goodwill as at the date of acquisition, 45,000. So no extra work there. They then tell you in the notes that goodwill has since been impaired by 5,000. So that's the first adjustment. Okay, we reflect that goodwill impairment, bringing goodwill down to 40. Now let's deal with my retained earnings and my NCI balance. Now, to calculate either of these numbers, we first need to establish what the net assets of the subsidiary were at various dates. So we're going to have to set up our working to net assets of the sub. And I'm going to do something a little bit unorthodox here. Okay, I'm going to do something that we've not been used to seeing from the past. I'm going to break this question down into what my net assets were at the acquisition date and what my net assets were at the date of partial disposal, in this case on the 31st of August. So the share capital was 100 for Billings. We know that will be the same at acquisition and the date of partial disposal. So my movement is 0. My retained earnings at the date of acquisition was 250. We need to work out what the retained earnings of the subsidiary were on the 31st of August. I'll give you one moment. You tell me, what were my retained earnings on the 31st of August? One minute. 328, says Rachel. I would absolutely agree with you there. So my retained earnings at the beginning of the year, they tell you, were 304. The profit for the year was 36. I prorate this by 8 months out of 12, so I must get 328. Thank you for your contribution. Net assets at acquisition, 350, 428 at the partial disposal date. My overall movement up to the date of partial disposal is 78. I am then going to do the same working, but comparing the balances. Oops, sorry, thank you for that. I just realized that my screen was frozen. Thank you, Sabine. So what I had done was show retained earnings at the partial disposal date of 328,000. I am now going to do the same working, looking at the balances from the date of partial disposal to the year end, to the SFP date. Share capital remains 100. My retained earnings we had calculated as 328 at the date of partial disposal. And as at the year end, well, that's going to be my 304 plus the 36, giving me 340. So we've got net assets at year end 440. At the date of partial disposal, 428, and we've got the overall movement from August to the end of December of 12. Now we have done this, we can work out the non-controlling interest adjustment. Okay, like we saw in the notes previously, where we've got this partial disposal, we need to do an extra adjustment, an extra working. So I'm actually going to call this working 6. Okay, so we're going slightly in a mixed order, but you know, working 4 is always the NCI calc, working 5 is always group retained earnings. So we'll call working 6 the NCI adjustment at partial disposal. So here, what we do is calculate what was the value for the non-controlling interest at the date of partial disposal based on the old shareholding. In other words, we take 10%, which is the old non-controlling interest shareholding, and multiply it by the net assets at the date of partial disposal. Well, that's the 428, isn't it, that we just calculated from above. 10% of this figure gives you 42.8. We compare this to what the non-controlling interest balance is based on the new shareholding. Well, that's 20% times 428, giving me 85.6. Okay? So can you see, if we're going from 90% down to 80%, the NCI must be going from 10% up to 20%. So overall, we have an increase in the non-controlling interest balance of 42.8, which makes sense. Okay, we're doubling, the NCI is doubling its shareholding from 10 to 20. So we pose through this NCI adjustment, this new double entry we've learned. What we do is debit cash the proceeds received. From the question, I believe they tell you that's 70,000. We credit the non-controlling interest the increase. Well, that's the figure we've just calculated above. That's the 42.8. And then your balancing figure is going to be a gain that we record within equity. Okay? Now, the notes are fairly generic. They say equity, but read that to mean the group retained earnings. So where are we going to reflect all of these adjustments? Oh, thank you, Sabine. Okay, we've got a second auditor in the room. I've just made a typo here. That is indeed 27.2. Thank you for that. We've posted this journal entry. We need to reflect it in our workings. The debit to cash goes into the consolidated SFP. The credit to the NCI will be shown in working 4. The credit to equity can be shown as an increase in my group retained earnings working 5. Okay. So we can deal with the first adjustment. We're debiting cash for the proceeds received. They do tell you in the question that this was never accounted for. So we're debiting cash the proceeds received. Let's complete the subsequent workings. So next up is your non-controlling interest. So I'm going to break this working down into several bits. Okay, I'm going to break it down. I'm going to do quite a long version of this working, and then I'll show you a quick shortcut at the end. Okay, but I just want to prove to you why this adjustment works. And remember, we are applying the proportionate method. Okay, so as at the acquisition date, remember that the net assets were 350,000. Okay, we had calculated above 350,000 at acquisition. So we take the NCI percentage at the date of acquisition times the net assets. Okay, it gives you 35. And then we go up to the disposal date, or up to the partial disposal. Well, from the 1st of January to the 31st of August, the non-controlling interest had its 10% interest, and during that time, the movement in the net assets of the sub was 78,000, wasn't it? We calculated it from our working too. So we add the 7.8%. And then from partial disposal to the year end, well, that was when the non-controlling interest shareholding increased. It went from 10% up to 20%. So we take its new shareholding times the movement in net assets from the partial disposal date to the year end. So that's 20% of the 12. Okay, so these are the same figures we had calculated from above. I'm taking the 78 and the 12. Well, that's going to give me 2.4. Almost done. We've got this NCI adjustment to deal with. Okay, so this credit to the NCI of 42.8, will we reflect that in working 4? we had shown an increase of 42.8. So overall, my NCI balance at the year end is 88,000. Okay? And now we've just completed that balance. This is the long way. This is the proof to you that this NCI adjustment works. Okay, this is the proof to you that 88 is how much we should be allocating as the balance attributable to the NCI. This is quite lengthy. Here's a shortcut. Because we're applying the percentage of net assets method, how about we just take the NCI percentage and multiply it by the net assets at the year end? Well, we had calculated that as 440, didn't we? So that gives you the same number, 88,000. This is a lot quicker. This is the method you should use. But for those of you who are curious, okay, who like to know how things work on a step-by-step basis with accounting, here is your proof. Nearly there. Working 5 is your group retained earnings. Take 100% of the parent's retained earnings. Well, the company has 1,190 in opening retained earnings. We add on the 120 profit. My retained earnings at the year end is 1,310. We then need to take the parent share of the change in retained earnings of the subsidiary since acquisition. So we take 90% times 78. Okay? For the first 8 months of the year, we had 90% of the subsidiary shareholding. So that gives you 70.2. And then for the last 4 months of the year, we only had 80%. So we take 80% times the movement in retained earnings from end of August to December. That 12 we also got from the working 2. And then we deal with other adjustments that could impact group retained earnings. Well, we've got this NCI adjustment to reflect. Okay, remember, we did that double entry earlier. We credited equity group retained earnings by 27.2. So we need to reflect that adjustment in working 5. Don't forget your goodwill impairments. Remember, goodwill impairments under the proportionate method are allocated entirely to the parent, entirely to working 5. So that will give you 1,412. I'll give a moment there for Jack to audit my figures. Let me know if I need to update anything. Hopefully he'll give me the all okay. Oh, brilliant. Thank you, Jack. No further work noted. Right. So let's go back up to our statement. Love that phrase. I used to be an auditor myself. That was my favorite word ever, favorite phrase ever. No further work required. So let's finish up our statement. We said retained earnings was 1,412. NCI was 88. And then the remainder is just adding up the figures. As soon as you've got your total assets, copy that same figure down into your total equity and liabilities. Don't ever add up your equity and liabilities just in case it doesn't balance. but I have it on Jack's assurance that this does balance, so I'm happy. Okie doke. So in this adjustment then, we have now successfully dealt with a partial disposal, but still maintaining control, going from a subsidiary to another subsidiary. Okie doke. In terms of our plan for the day then, we can knock off disposal of the associates. We're still dealing with partial disposals, so let's stick with that for the moment. Going over to the next section, what happens when we go from having a subsidiary to an associate? Okay, so when we go from having a subsidiary to an associate, let's say where we're going from an 80% stake down to a 40% stake. Well, the rule is, or what I like to think of it as, is that we pretend like we've sold the entire thing, and then as if we've bought a brand new associate. So we're going to treat the subsidiary as if it was disposed of in its entirety, and therefore calculate a profit or loss on disposal. We're then going to pretend like we've gone off separately and acquired an interest in an associate. That's the approach to take. Let's look at the steps. So because we're going from a subsidiary to an associate, we have lost control. Okay, there's going to be a gain or loss in the consolidated statement of profit or loss. The way we calculate that is, as per your notes, we compare the proceeds received to the carrying amount of the subsidiary just prior to disposal. But there is this extra bit we need to consider on top of when we calculate a normal profit or loss on disposal, and that's this section here. So we have the proceeds received, we add on the fair value of the interest that we have retained. So in this case, the 40% stake that we haven't really sold. We add on the fair value because this is how much we would have paid if, this is how much we would have received if we sold the entire subsidiary. We record the proceeds for the shareholding we did sell, and then the fair value of the interest retained, which would have been the proceeds we received if we sold all of the investment. In terms of your double entries, what you're doing is debiting cash and debiting your investment in the associates. We remove the carrying amount of the subsidiary recognized just prior to disposal. And that means effectively crediting the net assets of the sub, moving all of its assets and liabilities away from the consolidated accounts. We credit the goodwill. We no longer control the sub. Okay, we have disposed of it. We dispose of the goodwill. We debit the non-controlling interest. And then any gain or loss is going to be a profit or loss in your statement of profit or loss. So that profit and disposal is your balancing figure. In the consolidated statement of financial position at the year end, we equity account by reference to the year end holding. Okay? So what you're going to have is an investment in the associate. You're going to start off with the fair value of the interest retained. And then you're going to add the parent's percentage. So that's the new percentage ownership in this example, the 40% times the change in net assets of the associate up to the year end. Okay, you're going to do any other adjustments, so knock off any impairments, associate perps, etc., to get your closing value. In the consolidated statement of profit or loss, we consolidate the results up to the date of disposal. We equity account after the date of disposal, and we include a gain or loss as calculated above. We do have a lovely Test Your Understanding 7 testing this particular point. Do we have time to do it? I think we should, but we're not going to do all of it. Okay, so in this example, we are going from a subsidiary to an associate. Don't have time to do the entire exercise, but we'll do a proportion of it. So we've been given extracts of Kathmandu and Nepal. We've got the P&L and the Stocky. On the next page, we've been given some additional information, and we're required to prepare the consolidated statement of profit or loss. So we don't have time to do that. All I want to do is calculate the profit on partial disposal. Okay, so here we can see that the accounts of the Kathmandu group do not include the results of Nepal. On the 1st of January, Kathmandu acquired 70% of the shares for £100,000 when the fair value of the net assets were 110. Nepal has equity capital of 50, and at that date, the fair value of the non-controlling interest was £40,000. It is group policy to measure NCI at fair value at the date of acquisition. So what we are told here are details about the original acquisition, and we know that they apply the fair value method in measuring NCI and goodwill. Nepal paid its 2009 dividend on the 31st of March. What dividend is that? Okay, so it must be this dividend here, £10,000 paid on the 31st of March. Goodwill has not been impaired. That makes our life easy. And Kathmandu sold half of its holding on the 1st of July for £10,000. The disposal is not yet recognized in any way in Kathmandu. The residual holding of 35% has a fair value of £100,000 and leaves the Kathmandu group with significant influence. They're telling you significant influence because that is a hint that Nepal has become an associate. Kathmandu sold half of its shareholding, so we are going from 70% down to 35%. Okay, we're losing control, but we've still maintained significant influence. In other words, we're going from a sub to an associate. We don't have time, unfortunately, to calculate the entire or prepare the entire consolidated P&L, but we can at least work out the profit on disposal. I'm going to work handwritten, I think, because, again, this is a new topic. So nice pens out, okay, clean sheet of paper, very beautifully written out notes. Okay, let's talk through the consolidated, let's talk through the profit on disposal or on partial disposal of a sub. Okay, So how do we work out the profit on disposal? We compare the proceeds received to the carrying amount of the subsidiary at the date of disposal. Proceeds, I believe, were 100,000. We've got this extra line to include because it is a partial disposal. So as well as the proceeds, we include, and I'll asterisk this in red so you know that this is new, we include the fair value of the 35% interest that Kathmandu has retained. Well, they do tell you in the question that was 100,000. So your total deemed proceeds are 200,000. This is how much Kathmandu would have received if it sold its entire shareholding. And from this figure, we deduct the carrying amount of the sub as at the date of partial disposal. So we must consider the net assets, for which we'll need to do a working. We consider the goodwill, for which we'll need to do a working, and the non-controlling interest, for which we will need to do a working. Okay. So, net assets at the date of disposal. Well, net assets consist of your share capital and your retained earnings. So your share capital is 50,000. Okay, they mention it in the notes. They don't give you retained earnings as at the 30th of June, but they do give you opening retained earnings of 80,000. So what we can do is add on the profits up to disposal. We're told profits for the year were 36,000. The partial disposal happened 6 months into the year. Almost done. We need to adjust for the dividend, because we know that the dividend was paid on the 31st of March, which is prior to the date of partial disposal, and as such, it would have reduced the net assets of Nepal. That will give you net assets at the date of disposal of 138,000. Once you've calculated that figure, we can transfer it all the way up to our working one. Okay. Next up, we have to calculate the value of goodwill at the date of disposal. And we know how to calculate goodwill. We start off with the consideration transferred to acquire Nepal. That was 100,000 going back into the notes. And then we add on the fair value of the non-controlling interest at acquisition. It's the fair value because they do tell you that they apply the fair value method. And that 40,000 was given in the question. We knock off 100% of the net assets at the date of acquisition. Well, they tell you in the question that was 110,000. Also given in the question. So my goodwill was 30,000 at the date of acquisition. we know from the question there have been no impairments to date. So my goodwill at the date of partial disposal is 30,000. Once you've calculated that figure, transfer it all the way up to your working one. Last thing left to calculate then is the value for the non-controlling interest at the date of disposal. So we start off with the fair value of the non-controlling interest at the date of acquisition. I believe they told you that in the question. It was 40,000. We then take the NCI share of any change in net assets of the sub from acquisition to the date of partial disposal. Well, my acquisition net assets were 110,000. Okay, they told you that in the question. And from my workings, I had calculated the net assets at the date of partial disposal as 138. So that's the figure I need for my calcs. %30 times the difference of those two figures should give you 8,400. 48,000. Once you've got that figure, transfer it back to working one. So we get our overall profit or loss on partial disposal of Nepal. Overall, our reduction is going to be 119,600. That was the carrying amount of the sub at the date of partial disposal. It's going to get you a profit or loss on disposal, or a profit in this case, of 80,400. Okay, so just giving you a moment there to jot down those notes. Nearly done with partial disposals. So we've seen what happens when we go from a subsidiary to a subsidiary. We've seen what happens here when we go from a subsidiary to an associate. Okay, that's what's happening here. We're going from a subsidiary to an associate. The next section looks at if we go from a subsidiary to an ordinary trade investment. Well, the gain or loss is calculated in exactly the same way as for the associate, so nothing new to learn there. The interest retained is initially recorded at its fair value as included in the gain calculation. Okay, so it's the fair value of the interest retained. Initially, we record it at fair value, and then subsequently, because we have an ordinary trade investment, we follow IFRS 9. Okay? And I'll keep you in suspense there because we have a whole new world of excitement and jolly times to be had when we look at IFRS 9. In the statement of profit or loss, we consolidate up to the date of disposal. We include any dividend income after the date of disposal, and we have a gain or loss in the P&L as calculated previously. On the next page, we've got the other variation where we're going from an associate to an ordinary trade investment. So some shares are disposed of but an investment is retained. Okay? Now, we will have a gain or loss on the disposal of some of our shares. Okay? So how do we calculate that gain or loss on disposal? Well, we compare what we would have received had we sold the entire associate. So we compare what we would have received if we had sold the entire associate with the carrying amount of the associate as at the year end, as at the date of disposal. The difference is going to be any profit or loss on disposal. Only we didn't sell all of our investment in the associate. We only sold part of the shareholdings. So we've got this extra line to include, being the fair value of the interest retained, of the percentage shareholding we didn't sell. So these combined figures would tell you how much we would have received if we sold the entire investment in the associate. Okay, and we use that figure to calculate the proceeds, to calculate the profit or loss on disposal. Now, we don't have an exercise for this, but I would like to give you the double entries. So the proceeds are going to be a debit to cash. It's how much we've received for selling the shares, okay, or part of the shares. We debit our investment. Okay, it's going to be a simple trade investment, so it's an investment, or if you like, a financial asset. And we credit our investment in the associate. Your balancing figure is going to be, well, could be a debit or a credit. It goes to the P&L as a gain or loss on partial disposal. So these are the double entries. This is the calculation. The interest retained, so that simple trade investment, is initially recorded at fair value and subsequently follows the rules of IFRS 9. In the statement of comprehensive income, we equity account up to the date of disposal, include dividend income after disposal, and we include a gain or loss as calculated above. Gosh, there's so much to remember here. Luckily, the workbook has been updated to now have a nice, nifty kind of summary of all the calculations and all the variations of where we've got disposals. So going from a full disposal to partial disposals. Okay, so a nice one to have tabbed up for your exam file. Okay, one thing to order online would be sticky tabs, highlighters, okay, anything to organize your notes nicely. So in terms of our original plan for the day then, we've now got rid of partial disposals. Okay, it looks like a lot left to deal with, but I promise the first 2 bullet points were the longest. Let's take a look now at the other direction. First, we were selling shares. Now we are acquiring shares. So here we're going, or here we're performing step acquisitions. Okay, so we've got a number of scenarios. We could be achieving control. Okay, so you can see we're going from 40% up to 60%. In other words, we're going from an associate to a subsidiary. Well, where we've got these kind of step acquisitions, any previous shareholding is treated as having been disposed of and then reacquired at fair value at the date of acquisition. So similar kind of idea. Pretend like we've sold the entire investment in the associate and then pretend like we've bought a brand new subsidiary. Any gain or loss on remeasurement to fair value of that investment is recognized in profit or loss or other comprehensive income as appropriate. Okay, and we'll talk about that more in a moment. Goodwill is calculated using the fair value at the date of acquisition. We know how to calculate goodwill. Okay. It's just like your standard working 3 from the consolidated SFP, only this time we have a slight tweak. So we start off with the consideration transferred. Okay, that's fairly straightforward. But then we add the fair value of the previously held equity interest at the date of acquisition. Okay, so that's going to be the fair value of the shares you already own. Remember, we're going from 40% up to 60%. So this is the fair value of that 40%. We add on the NCI at the date of acquisition, knock off the 100% net assets at the date of acquisition to get your goodwill at the date of acquisition. Okay, so this is very similar to your typical goodwill working. The only new line, the only thing we haven't seen before is this fair value of the previously held equity interest. So that's an extra line we're going to add to our calculations. Let's take a look at Test Your Understanding 8. So in TYU 8, what we need to do is show the journal entry required in respect of the 50,000 shareholding on the 1st of June and to calculate the goodwill acquired using the proportion of net assets method. Okay. So here we're achieving control on the second acquisition. Bath has 1 million shares in issue. Bristol acquired 50,000 of the shares. Bristol acquired 50,000 of the shares on the 1st of January for £100,000. So 50,000 shares out of a total 1 million share capital in issue gives you a 5% investment for £100,000. These shares were designated as fair value through other comprehensive income financial assets. Whoa, what on earth is that? Don't be too thrown off by that long-winded title. When we talk about investments classified as fair value through other comprehensive income, that is a IFRS 9 classification. So it is a type of trade investment. Okay, you'll see later on that we've actually got 3 types of classifications. This question has gone with fair value through OCI. What that means is that these shares, okay, these 1 million shares are restated to fair value at each year end. Gains and losses go to other comprehensive income. So we'll just make a little note to the side. We restate the investment to fair value at each year end. Gains or losses go to other comprehensive income. That's in a nutshell the consequence of being classified as fair value through other comprehensive income. You're going to learn about that so much more intimately later on in the course. So the shares were designated as fair value through OCI, and on December X8, their carrying amount was 230, and the increase in fair value had been recognized in other comprehensive income held within equity. That's correct. Okay, so that's exactly what they should have been doing. On the 1st of June 2009, when the fair value of Bath's net assets were £4 million, Bristol acquired another 650,000 shares for 3.9 mil. On that date, the fair value of the 50,000 shares already held was 250,000. So what we're doing is going from a 5% holding up to a 70% holding because we've acquired more shares. Let's show the journal entries and calculate the goodwill that has been acquired. You could probably squeeze this in below your notes, but I'm going to do a take out a brand new page, write out my notes very clearly. This test your understanding, the scenario in this test your understanding is very similar to a question from the question bank. Okay, so, it's very similar to a question called IUP. So it's worth your while having these notes written out very neatly, very nicely for you to be able to follow later. Okay. So on the 1st of January 2006, we know that the shares were originally acquired. What we're going to do is debit the investment 100,000 and credit cash. Okay, this was the original acquisition. And then we're going from acquisition to the previous year end, the 31st of December 2008, we would have had gains on the remeasurement of this investment. We know that there have been previous gains of 130,000 as per the question. So we'll have to debit the investment and credit other comprehensive income. Okay, and that is up to the previous accounting year end. We then get to the 1st of June. And that is the date of the increase in shareholding. That is when we go from 5% up to 70%. So what we need to do is revalue the investment to its fair value of 250,000. That's what it said in the notes. The fair value of the 5% retained was £250,000. So we're going to revalue the investment up to this figure. That basically means we're going from 230 up to 250. In other words, we have a gain of £20,000. What we're going to do is debit the investment and credit other comprehensive income. Oh, my apologies. Thank you, Sabine. I have so many good auditors in the house. It's 2009, not 2008. Thank you for your input. So what I have done is remeasured the investment to its fair value of £250,000. That increase, that gain, is recognized in other comprehensive income. I'm going to use another color to write this. Okay. So the fair value through OCI reserve that sits in equity is now going to be 150,000, isn't it? Okay, it's the previous gains of 130 plus the 20,000 gain we have just recognized. So the balance sitting in reserves is now 150. This remains. in equity. It is not reclassified or recycled, sometimes we say, to the P&L. So in case anyone's wondering, all these previous gains we've had on this investment, we've been building them up in other comprehensive income, and indeed they stay there. Bristol now has a 70% sub. As such, Bristol must consolidate the results of the sub. Furthermore, Bristol must calculate a goodwill balance in relation to this sub. The way we calculate goodwill, where we've achieved control in stages, is to first of all start off with the consideration transferred. That's 3.9 million they told you for the 650,000 shares. We then add the fair value of the 5% interest that Bristol had originally acquired. That was 250,000 per the notes. We then add on the NCI percentage, so that's going to be 30%. Times the 4 million fair value of net assets. Knock off 100% of the net assets at acquisition. We have a goodwill figure of 1,350. Okay, so I'll just give you a moment to finish jotting that down. So we've got a nice example here of TYU8. What happens when we go from a simple trade investment to a subsidiary? Okay, beautiful. Now, we've still got a little bit left to do in terms of step acquisitions. In this example, we went from an investment to a sub. The other scenario we're going to take a look at is where we go from a subsidiary to a subsidiary. So, for example, let's say we're going to let's say we're going from 60% to 80%. Okay, in that case, we had control before, we've got control afterward. Okay, there's no change in the control status. There's no change in the classification of the investment. We're staying from sub to sub. Therefore, no gain or loss is recognized. Goodwill is not remeasured because, remember, goodwill is something that only ever arises at the date of acquisition. It is only ever adjusted subsequently for goodwill impairments. We do not go back and adjust goodwill if there's been any change in ownership. So that goodwill is not remeasured. The only adjustment we do deal with is the difference between the fair value of consideration paid and the change in the NCI that is adjusted for directly within equity. Okay, so here we've got test your understanding 9. Gordon has owned 80% of Mandy for many years. Gordon is acquiring or considering acquiring more shares in Mandy, which will decrease the NCI. Okay, that makes sense. The NCI of Mandy has a carrying value of £20,000 with net assets, with the net assets and goodwill having a value of 125 respectively. Gordon acquires an additional 5% of the Mandy shares for £4,000, leaving a 15% NCI. So can you see here that Gordon had 80% and bought an additional 5% of the shares, so has gone up to 85%. Okay, we're going from a subsidiary to a larger subsidiary, if you like. Okay. So what we need to do here is work out the amount of the NCI adjustment, of the non-controlling interest adjustment. So they tell you in the question that initially the carrying value of the non-controlling interest was £20,000. So 20% being the NCI is valued at £20,000. If it is the case that Gordon has acquired an additional 5%, then the NCI balance must have decreased to 15%. If Gordon is going from 80 to 85, then the NCI must be going from 20 to 15. So 15% of the non-controlling interest is going to be valued at 15,000. Can you see overall we've got a decrease in the NCI of £5,000. Okay? That's going to be our debit. That's the change, that's the adjustment in our non-controlling interest. The double entry, you can see above, is to debit the non-controlling interest, this adjustment figure, this £5,000, and we credit cash how much Gordon has paid for these additional 5% of the shares. Well, Gordon has paid £4,000. The value of NCI has decreased by £5,000, and therefore Gordon has actually made a gain. Gordon has made a gain of 1,000, and that is recorded directly in equity. You can reflect it in retained earnings. Okay. Last section on partial disposals is on achieving significant influence. So where we go from an investment to an associate, well, that's when significant influence is achieved. We have an associate, and therefore we should be equity accounting for that associate. Any previous shareholding is treated as having been disposed of and then reacquired at the fair value at the date of acquisition. So we pretend like we've sold the whole 10%, and then we pretend like we've acquired a brand new 40% associate. Any gain or loss is recognized in the P&L or other comprehensive income as appropriate. It depends on how the investment had been accounted for previously in accordance with IFRS 9. You don't need to worry about that for now. It'll make more sense later. The investment in the associate is then calculated as the consideration transferred for the additional shares. In fact, let's give you a few double entries so you're happy there. The consideration transferred for the additional shares. We include the fair value of any previously held equity interest. So that is going to be your credit to the investment. That is your financial asset. And instead we replace it with our new investment in the associate. Okay. that's not quite right. What have I done there? Yes, there we go. So what we are doing is crediting cash the amount transferred. We're crediting the original investment, which is our financial asset. And we are replacing it with an investment in the associate. So we add on our share of post-acquisition profits. Knock off any impairments to date. And we are ending up with our closing value for the investment in the associate. Okay. This value here should also be your investment in the associate. Beautiful. Lovely. Now we have looked at all of the different scenarios where it comes to dealing with partial disposals. I'm aware of the time. I'm aware that some of you possibly have other plans or need to go. So I'm going to call it a day here just because it's quite late. We're going to pick up tomorrow, okay? And disclosures, consolidated cash flows, it's not a huge chunk of the syllabus, so we can pick it up. It'll only take a little bit of time tomorrow. Okay, so I'll just go back to that previous page so you have the notes. Tomorrow you should be receiving an invitation to the WebEx, same as for today. A register will be taken by John and by Rob, my beautiful teaching assistants, so please make sure you are logged in using your full name as it appears on my Kaplan. I will upload these notes now, okay, or very, very shortly. So thank you for giving up your time to attend this session for Bank Holiday. I'm sorry we couldn't get through everything, but I will finish it up tomorrow, and then we'll cover our remaining chapters. See you all later, team. Just to clarify, today is the end of the session, so I will see you all tomorrow morning. Good evening, everybody.